The start of cash equity trading. I'm Tom McKenzie in London, and here are your top stories. Beats, but no bounce. Global stocks stall as China records its second slowest growth since the 1970s, even as most data top estimates. But Goldman and UBS join bullish bets on the reopening. Disappointing deal-making. Morgan Stanley and Goldman Sachs wrap up earnings from Wall Street's biggest banks, with both seen taking a hit from investment banking. Plus, it is, of course, day two at the World Economic Forum, where we will have more blockbuster interviews, including the UBS CEO and OPEC Secretary General. Let's take a look at the futures then as we weigh up that data out of China. Yes, the fourth quarter came in slightly better than the estimates, of course, slightly less bad than the estimates, and the volatility as we look ahead to the rest of the year in terms of the growth picture in China. And for last year, it was the second worst print in terms of GDP for the full year since the 1970s. The FTSE 100 opening flat, a little bit of profit taking then ahead of what is expected to be the market risk potential around the Bank of Japan. More bond buying, a third straight day from the BOJ there. They now own more than 50% of that country's bond market. It's incredible. The FTSE 100 currently down 0.2%. Here in the UK, we had wage data coming through at a record, posing a challenge arguably for the BOE and underscoring expectations that there will be a 10th consecutive hike from that central bank next month. Over in France, the CAC currently down 0.1%. Germany flat, and the Spanish IBEX in a similar territory, similar picture there. Philip Lane, by the way, of the ECB, telling the Financial Times that rates will have to move into restrictive territory. Currently at 2%. He described that as neutral. Economists surveyed by Bloomberg expect rates from the ECB to get to 3.25% by about the middle of this year. Let's have a look at how things are playing out cross asset then. The US market reopening, of course, after a national holiday yesterday. Futures pointing lower by 0.3%. The benchmark 10-year at 3.54. And the Japanese yen, of course, in focus for us all this week on the back of expectations, or at least stimulus, I should say, not stimulus, easing back on stimulus. Will they do that, the BOJ? There is, of course, a lot of speculation about where they go with that policy decision around yield curve control. 128 on the Japanese yen, not a lot of movement, just 0.1%. Brent crude in focus, $84 a barrel. That's a gain of 0.3%. Goldman Sachs and Jeff Curry saying that there is a Goldilocks scenario now for the commodities sector on lack of investment and that demand coming through from China. I think we're going to look at a couple of individual stories and in the stock space, and one of those ties into that call from Goldman Sachs. Rio Tinto gaining 0.3%. They came out with an update in terms of iron ore production, an increase in the most recent quarter of about 4% in terms of iron ore, and they expect to see pretty decent demand for copper as well, tying into that theme from Jeff Curry of Goldman Sachs. Renault gaining 0.3%. We're hearing reports out of Japan that the CEO of this French automaker will be traveling to that country this weekend to work with Nissan on a potential deal, and they could have that deal by the end of the month in terms of how they restructure that alliance. Important for Renault, of course, going forward. Lindt, this was a beat in terms of the guidance. This is the chocolate maker out of Switzerland, gaining a little over 1% in terms of the guidance on margins, and they expect to see sales growth of between 6 and 8% this year. Let's get over to Bloomberg MLive Managing Editor Mark Cudmore. Mark, you, of course, are also drilling down on all things BOJ for us.
Yes, Tom, good morning. The BOJ tomorrow is a massive binary event risk for global markets. The BOJ has little credibility with traders out there. They are being challenged on an exceptional degree, and that is why they had to buy almost $100 billion worth of JGBs in just 4 days to maintain their yield curve control. At that pace, they would end out owning 100% of the JGB market by the end of the year, which would be absolutely, in explicit terms, monetizing the debt. Yeah, and it is the largest government debt pile in the world. So it's really quite extraordinary things happening in Japan. I want to provide one angle for why they lack credibility. Well, they claimed the slight tweaking of their yield curve control policy in December, which was a surprise to the market, wasn't about economic conditions. It wasn't about winning the war against inflation. They said they're going to persist with easing. It was about market functioning. Well, that hasn't worked out well. This is the Bloomberg Liquidity Index for Japanese government securities. A higher number means wider spreads, less liquid. And you can see the liquidity started getting worse and worse since about last summer when the BOJ speculation started ramping up. What's actually happened, this red line with the December meeting, is market functioning has got worse since the meeting. And I want to show one other chart just to show kind of quite how extreme it is. It is the yield curve overall. There's a massive kink in the 10-year. So now this green, dark green line is where we are at the moment. And you can see the yields in the 8-year and 9-year are way above, about 12 basis points, what you get in the 10-year, which is pushed back down arbitrarily by the Bank of Japan. Now, this was the distortion. It's a bit harder to see there probably on TV, but it's a much smaller distortion a month ago before the December meeting. So, i.e., the whole curve is getting more broken since the last meeting. They claimed it was about market functioning. They've made the market much worse. Are they going to persist with this easing, which is completely kind of contrary to the rest of the world for another meeting? Maybe so. The thing is, if they hold the line tomorrow, they probably have to hold till after April, and there's a new governor, and that's why there's so much speculation ramped up about this meeting. If they do move policy, there will be implications for all global assets.
And that rationale is seeming to break down, isn't it? Brilliant analysis and breakdown of the implications of that all-important BOJ decision. Thank you very much indeed. Of course, Bloomberg MLive Managing Editor Mark Cudmore. Now, coming up, we are, of course, live in Davos for the World Economic Forum. Do not miss our interview with UBS CEO Ralph Hamers. That is coming up next. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
exclusive live from Berlin, where German Chancellor Olaf Scholz sits down with Bloomberg editor-in-chief John Micklethwaite. A wide-ranging conversation only on Bloomberg, your global business authority.
Welcome back to the Open. We are 8 minutes into your European trading day. European stocks just eking out some very, very modest gains at this stage in the trading session. This Tuesday morning, futures in the US, the S&P E-mini is pointing lower by 0.3%. Let's get back to what's happening in Davos then. Day two, of course, of the World Economic Forum. Major decision makers and market movers are meeting in the Swiss resort town for the WEF, World Economic Forum. Let's get to Bloomberg's Manus Cranny then, who is on the ground with another fantastic guest. Good morning, Manus.
Tom, a very good day to you. Yep, a little bit nippy up here, but we've encouraged Ralph Hammers, the CEO of UBS, to join us on the rooftop. Good to see you this morning.
Good morning, Manus.
So if I look back last year, it was a pretty bruising year. There was nowhere to hide. Equities, bonds, really, really trashed. Yeah. Wealth preservation was hard to do. We've had a sugar rush at the start of this year. Yeah. Is it too soon?
I don't think it's too soon, per se. It is too soon to kind of talk of a trend, and it is too soon to talk about inflection. We do think 2023 is the year of inflection. Just go back last year, the war, the sanctions, the energy crisis, supply chain still faltering. I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
The natural corollary to that is you as a house were way ahead on your call on China. You've reaffirmed it this morning. Is that movement from China, has that been reflected by the clients? Are they much more active in taking China risk?
Well, we've seen more activities, but we have certainly advised them to go long on China and to be overweight on China. That's what we came out with on time, I guess. I think we were all a bit surprised as to the speed at which China opened up, but I think. Advising the clients, and they really have come, and you know that from the third quarter, clients in periods like this need more and more advice. They really come to me, I'm talking to them, and they're saying, well, okay, help me reading these data, help me reading these trends, where should we go? And basically they put a lot of money with us to manage for them, right, in the third quarter.
And are you saying cash first, reflect, and wait for a pivot? Or are you saying actively deploy, but judiciously? Which is the narrative for you?
We're still cautious as to the balance that you bring, and but there is moments to invest. There is absolutely moments to invest.
The other big debate is this: peak inflation, peak rates, and peak liquidity. Now, there's two bids there, and there's one offer. Yeah. If I look at the inflation narrative, the consensus is building peak inflation, and it will drop precipitously. Are you expecting a precipitous drop in inflation?
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay. And there's a reason for that. If we truly look at what has happened to us in the world over the last 3 years, we do think that we're going into the era of security. It's energy security, it is about food security, it's about technology security. For that, part of the supply chains that we are still dependent on will have to be rolled back, which basically means you bring labor back, you have to invest. The energy transition is still at its infancy, at its start. Lots of investments will have to go into becoming less dependent on energy from other countries. So I do think that inflation will be higher than what we are used to in the past. So it will not come down to the 2% that we are used to. So we'll have to work with that, but it will decrease from here.
To finish off with the macro then, if it's higher inflation than we're used to, then Ralph, the corollary to that is higher interest rates for longer. Do you think we make it to 5% and over 5% and stay there 2023?
I actually think that, it will peak around in dollars, right?
Yes,
around
dollars.
5%. Euro around the 3%, Swiss franc around 1.5%. And then I do think that they will come off the policy of hiking further, maybe stabilizing, see what damage it brings to the economy, and then lower again.
So that's whether they can deliver that soft landing in the States. Let's talk a little bit about the future and the growth, because a wonderful headline, UBS is not buying Credit Suisse. No shock, but nor are you in acquisition mode. What goes through my mind between the chairman and the CEO, you're full bull on China. You told me that last year. Colin, it would sound, is full bull on America. How does that live together? Where will you invest more to grow, China or the US?
We've been very clear from the start. When I came out with my strategy 2 years ago, just over 2 years ago, we said, you know, it's a barbell, right? So we will focus on Asia, that's where entrepreneurial growth will be, including China, and we will focus on the US because that's where entrepreneurial wealth growth is as well. So from the beginning, we've said there is a two-pole strategy here in terms of growth supportive. Clearly, China wasn't there from a COVID perspective, but long term, we know that that's where you need to be. And in the US, we're already very large as well, and that's what I've said from the beginning as well. That's where we need to continue to invest, which is what we did.
And that investment scenario, if I look at the cost-to-income ratios in the United States, they're high. They're high relative to everywhere else for you, around 80%. So this is a bit of a roll of the dice. If you're going to grow in America, you're going to have to spend and look large. Are you prepared to do that with a cost-to-income ratio at 80%?
Yeah, we have been very clear on our commitment to the US already from the start, 1.5 years ago, as to what it is that we need to do. First, we need to grow the scale. Second, we need to support our financial advisors with much better digital tools. We need to develop our banking product offering as well on both the loan side as well as the deposit side. And we need to invest in digital also in order to help scale for clients to really access some of the information themselves. And we're launching some of these products as we speak.
Are you going to be able to then buck the global trend? Goldman's are cutting jobs. Other European houses are cutting and reviewing the fat of the land. From what you're saying to me, you're in expansion mode. Are you in full hiring mode and not a retrenchment mode?
We're not in retrenchment mode. We're also not in full hiring mode. We are hiring what we call for critical jobs. We are in a growth mode. I'm sorry to say, and we are a global wealth manager. That's where we see the growth. We see it in Asia, we see it in Asia Pacific, we see it in the Middle East. We are hiring, absolutely, because we have the momentum. And you've seen the third quarter results. On asset management, net new money coming through 18 billion. On net new fee generating assets in wealth management, just over 17 billion coming through. You see clients put a lot of trust in us on this one. So we're really bucking the trend if it comes to growth in wealth management and asset management.
Do you think we'll buck the trend, Ralph, and not have the classic recession that you and I would have lived through in various cycles? Are we going to skirt a recession in Europe? We haven't touched on that. Will we skirt a recession in Europe?
If there is going to be one, it's going to be a very short-lived and mild one.
And in terms of the wealth that comes into you, the inflows that come into you, and we'll dig into this a little bit more in 2 weeks, but that inflow that we saw, has there been a material inflow from the Credit Suisse debacle?
I was giving you the numbers third quarter.
I know.
It has nothing to do with Credit Suisse. All has to do about our own strength, how we deal with our clients. Our clients put so much trust in us. I go out to clients all the time. They really want our advice. We have a credible offering. That's what we're investing in. They know that wealth management is what we do. It's not what we also do. This is our core business.
And to make those inflows that we talked about stick, is it leverage? What is it they really want? Is it product, alternative product? Is it leverage, or is it credit? What is it that drives them to stick and hold with you?
It's the trust and the relationship with the advisor for sure. It's good investment advice. And you know that our CIO is really good at that. His strategies have worked all the time. He's also calling out the area of security. He sees it very, very clearly as to where things need to go. It is about private markets for sure, still, and it's about sustainability.
Okay, Ralph, we'll pick these topics up. Let's see what the fourth quarter brought to us. We'll catch up in a couple of weeks. The message from Davos there is about the little bit of caution. Let's not let the horse races out of the gates just too quickly on risk. Ralph Hamers, the UBS CEO. Tom.
Manus, really, really great. Really enjoyed that interview. Thank you very much indeed. Manus Granny, of course, on the ground in Davos at the World Economic Forum. The CEO there of UBS saying that they are advising their clients to go long on China. They see 2023 as being an inflection point. Coming up, we are speaking with DP World CEO and Chairman Sultan Ahmed bin Sulayem. That is live from the World Economic Forum, of course, in Davos. That is next. This is Bloomberg.
After hardly a full year of name, image, and likeness deals being a reality, UCLA quarterback Chase Griffin already has more than 20 deals with major brands, venture, and charitable groups, all while balancing graduating undergrad in just 2 years and fighting for playing time on the field.
Chase Griffin out of the gun. We are joined by UCLA quarterback Chase Griffin. Not just UCLA quarterback, but name, image, likeness superstar. I am psyched for this one.
This kid could actually be the president of the United States someday.
When it comes to building generational wealth, it's not about the money that you make in college. I'm very excited that I made the amount of money that I made last year. I am even 10 times more excited that I know how to make that money.
Season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Welcome back to the Open. We are 20 minutes into European trading day. Losses now just of 0.1% across the broader European index. One major index in Europe that is in the green. The FTSE Mid posting gains of 0.2%. Futures in the US pointing lower. The S&P E-minis by 0.2%. Let's get the Bloomberg Business Flash now with Laura Wright. Laura.
Thanks, Tom. China's economy grew at the second slowest pace since the 1970s last year, but fourth quarter data was better than economists had expected. GDP growth slowed to 3% in 2022 as the country doubled down on its now abandoned COVID zero policy. Growth slumped from 8.4% in the previous year. Meme stock investor Ryan Cohen is said to have taken a stake in Alibaba and is calling on the Chinese tech giant to increase its share buybacks. A source says Cohen built up a holding worth hundreds of millions of dollars in the second half of last year. Cohen has a strong following among meme stock investors and played a central role in the frenzy over GameStop. China Evergrande says auditor PwC has resigned after disagreements over its 2021 financial statements, adding to pressure on the indebted developer. According to a regulatory filing, Evergrande says the two sides could not agree on a timetable and scope of work. In a separate letter, PwC says it didn't receive key information needed for its audit work. That's the Bloomberg Business Flash. Tom.
Laura Wright here in London. Thank you very much indeed. Now, the global elites, of course, are in the mountains again for the World Economic Forum's annual meeting. They are back in Davos for the first time in 3 years. On the ground for us, of course, is Manus Krani with another fantastic guest. Manus.
Tom, thank you very much. Let's talk trade. We have Sultan Ahmed bin Sulayem, CEO, chairman of DP World, the man who knows where the flow is going. Mr. Chairman, welcome to Bloomberg. Thank you for joining me. I don't know, I want to get a sense from you. The IMF and the World Bank are full of doom about the outlook for the global economy. How do you view the prospects for 2023 this year? Are you as negative as that?
I'm not as negative as that. I think there's a lot of drama in the media. Yes, the World Bank has numbers, but I don't know whether all that will happen in 23. We heard it's going to be 2020 was going to be bad, and we were preparing for it. And then COVID came instead of the financial issues. We understand there are issues, but I think that business is capable to deal with it. There is a resilience. We learned the hard way during COVID, and I think we can overcome it.
Is China reopening the single most important piece of the global trade puzzle?
The question is it positive? Of course.
Yes. Is it? I mean, I think we all know from a sentiment point of view, it is positive.
Absolutely.
What's it going to do to world trade?
Well, definitely, China has to catch up with what they have not produced. During the lockdown, factories were closed. Orders are piling. It's very evident when you order something or you want to buy something, many items today have long-term delivery. That should fix it, I hope, in the next few months. They just opened. You can't expect it to happen now, but I expect to see some changes toward the last, maybe quarter of this year.
The question then is, can the world wait until the last quarter of this year to avoid a global recession?
Well, the world have dealt with it during COVID. They have dealt with it in the past. I think people learned to buy what they cannot buy from China from other places.
Tell me this, Treasury Secretary Janet Yellen, she's going to meet in Zurich with Vice Premier Liu. How important is it America and China progress in their relationship?
It is very important. Two of the biggest economies in the world. We can't afford a geopolitical problem. As businessmen, we know how to run our business, we know how to make money, we know how to cut costs. What we cannot know is what is happening in the mind of these big two countries. So if they're going to meet, that's a good sign. And if they're going to resolve some of the issues, to remove the fear. You see, all this gloom is about fear, about geopolitical, about what's going to happen. All these things are fears. And leaders can remove the fears.
So that would alleviate some of the drama and the fear of the world. One big theme between China and the US, which has come to talk more and more about, is onshoring and friendshoring. That is happening. What can you tell me about the impact of that on trade flows? And is that a threat to DP World?
Let me tell you, nearshoring has been discussed many times. Today, I think after the COVID issue, people realize that it's not only cheaper to produce outside China, it's also more reliable for the supply chain. Because once they close, the whole supply chain closed.
And will that momentum grow? Will onshoring, friendshoring grow? Is that going to ratchet higher?
It will happen. Let me tell you, for example, Apple today, they put a factory for the iPhone in India. They decided already.
Yeah.
So they are going to produce for the consumer market. But what's going to lead it is viability. If it's going to be viable, they'll do it.
Okay.
But nobody's going to do it for strategic reasons.
On supply chain, something that you and I have touched on several times when we meet, are you hiring more engineers? What are you going to spend on hiring on supply chain logistics?
On the digital side, we are hiring. On the digital side, last year we announced establishing our DP Meta World, which is our metaverse, which is really helping us. We started it. We had a target to start using it in December of last year, and we did. And it is really just the beginning. I believe there are many technologies today emerging at the same time. You got the metaverse, you got the robotics, you got the AI, all in one time. And imagine leveraging in our business on that. The rewards are unimaginable.
And on logistics tech, let's just finish off on that. I mean, the world's spending $9 billion a quarter. How much are you spending on logistics tech? We're up against the time, and I want to get to the UK.
I don't have a figure, but we are spending a lot. The biggest single investment today in hiring is logistics, no doubt about it.
That's going to be your alpha. I want to get to the UK because the pound has imploded. The economy is under serious pressure. Are you seeing material drop in trade flow from your ports in the UK? Anything material in the UK eco outlook?
No material. Actually, UK didn't have a problem economically. They have a political problem. And when the leaders, give the wrong message, everybody get affected. Today, I think they have a good leadership. They have a good plan. And the economic fundamentals of the UK are very strong. It's a big financial center. Nobody can deny that. And the ports are doing well.
Do you think the Liz Truss, the damage that Liz Truss and Kwasi Kwarteng did to confidence is gone? Has that passed?
I think it's going to go. If whatever left of it is going to go, because people need confidence. They need a government who will say, we want to do the right thing.
So the pound is not technically on its knees. It is bounced from parity. But has that presented opportunities? Are you prepared to deploy more capital into the UK?
Absolutely. We are expanding our port right in this middle crisis. We're adding a fourth berth.
How much will you spend in the UK just as an expansion? Approximately, is it $1 billion expansion?
I think something like 300 to 400 million pounds for this expansion.
Okay, Ireland. Where does Ireland, if at all, fit into your thinking? Have you visited? Have you looked at it? I mean, it is way ahead in terms of GNP relative to the UK, and it is the axis and gateway to Europe. Will it play? Will it feature for you?
It might. It might. Let's see how it will play. Because we follow cargo. We are a company that follows cargo. So if cargo is going to be there, we'll be there.
Where's the biggest opportunity for you as you look into 2023?
Utilizing technology, leveraging technology, combining it together, is going to give us an amazing opportunity, in my opinion.
Chairman, thank you very much for dropping by the Bloomberg studio. Great to hear your views and indeed your outlook. The drama that the media is making out of recession, maybe it just makes great headlines. Chairman, thank you very much. That is Sultan Ahmed bin Sulayman, Chairman and CEO of DP World. There you go, Tom. Apparently we make drama out of all of these headlines on recession. We need to be a little bit more confident. Chairman, Tom.
Manus, fantastic stuff. We are just reporting what the IMF and the World Bank are saying. But thank you. You got some headlines out of that interview, and that's the most important thing. Manus Granny with the Chairman and CEO of DP World in Davos. Now, looking ahead, we have got, of course, a big interview coming up with German Chancellor Olaf Scholz. What an interview. Bloomberg's editor-in-chief, John Micklethwaite, will bring us that exclusive conversation. It will be live. Stay with us for that. Let's check in on your markets then, 30 minutes into the trading day this Tuesday. And you do have a bit of downside across European equities now. The benchmark down 0.2%. The chief economist at the ECB, Philip Lane, telling the Financial Times that rates will need to move into restrictive territory, currently at 2% from the ECB, of course. The DAX currently down 23 points. The FTSE 100 off by 11 points, trading at 7,849. Wages coming in, the highest wage growth on record for the UK, underscoring arguably the need for the BOE to hike again. 50 basis points is the expectation at the next meeting. Let's switch it over and see how things are playing out across sectors. The other factor, of course, was the China data that investors are weighing through for the fourth quarter, but for the full year as well. Growth coming in, yes, above the estimates. 3% was the growth picture in 2022 for China as it wrestled, of course, with COVID zero and then the unwinding of that policy towards the end of the year, but well below the target the government had set itself. And then you have the questions around population declining for the first time since the 1960s, when there was mass starvation in that country. Across your sectors, you're seeing gains by chemicals leading up 0.2%, very modest. Just 5 sectors in the green this Tuesday morning. At the bottom of the list, personal care products currently down 0.6%. You're seeing a bit of strength in the currency space when it comes to the pound, 122. The Bloomberg Dollar Index is range-bound. It is, of course, a big day again for US bank earnings. That season continues. The numbers coming through. Goldman Sachs and Morgan Stanley due to report today. And who better to break it down and get a preview than Bloomberg's Charlie Wells. Charlie, what are investors going to be honing in on when it comes to Morgan Stanley and Goldman?
Well, the big theme really is going to be on that investment banking revenue slowdown. So JP Morgan had a miss on Friday, revenue down 60%, about Citigroup's same ballpark. So that's estimated to be in a similar range for Goldman and Morgan Stanley later today. But there will also be a focus on Goldman Sachs' strategic direction. Goldman had a really difficult 2022. Their EPS estimates have been on what I would call a journey, a downward journey, from about $11.60 this time last year to about $5.50. Now,
that's quite the journey.
That is quite a downward journey, and that follows a major reorganization and major layoffs.
And it's the retail part of the business as well. They're having to rethink that. How much divergence do you expect to see between the banks that are reporting today and the banks that have already come through with their results?
Tom, funny that you mentioned retail, because a lot of the banks that have already reported have large retail operations, so they're focused a lot on the consumer, whereas the banks today are more pure play investment banks, right? So that's Goldman after their retrenchment from Main Street, and also Morgan Stanley. And so we'll get more intel on what that deal flow atmosphere looks like.
Okay, so the deal flow atmosphere is going to be in focus. And in terms of a gauge as to the real economy as well, What are the data points you're looking for out of these earnings to give us a sense of how these banks are positioning for the growth picture?
Well, this is why we really care about bank earnings, right? These are really bellwethers for the American economy. They're enmeshed in so many parts of economic activity. And when you hear CEOs speaking over these earnings calls over the past few days, recession really has been sort of the elephant in the room. And so it's sort of, trying to prepare for worst case scenarios, but also trying to explain, why deals have been so difficult, but also to give a slight sense of optimism. So it's been a difficult task, but it is looking like, the consumer is in relatively good health. And one of the strands that we're hearing is that maybe there may be this realization that we're in a new normal, that interest rates may be staying relatively similar to where they are now, that businesses may come back to the table and decide they need these bankers.
How these banks are adjusting to that new normal, maybe looking at loan loss provisions as well. We spoke to one bank analyst yesterday who said he was surprised at how conservative banks like JP Morgan were around loan loss provisions. Charlie Wells, fantastic as ever, with a preview on Goldman Sachs and Morgan Stanley reporting later today. Coming up, the Financial Secretary of Hong Kong, Paul Chan, speaking to Bloomberg. That is again live from Davos. We will bring you that interview. It is next. This is Bloomberg.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is going out and hustling, bringing that money back, and just building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
You've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
Welcome back to the Open. 37 minutes into your European trading day. A bit of profit taking, arguably ahead of the event risk potential from the BOJ. Tomorrow, currently down 0.2% across your benchmark here in Europe. The FTSE 100 trading at 7,853, down 7 points. The futures on the S&P E-minis pointing lower by 0.3%. The China data coming in slightly better than had expected for the fourth quarter, but across the full year, growth coming in at 3%, well below the target set by officials in Beijing. Let's get the Bloomberg First Word News now, and I'll give you a roundup of some of the other top stories. The World Economic Forum's annual meeting is, of course, underway in Davos, with corporate executives and economists warning a global recession is likely this year. A PwC survey of business leaders late last year found 73% thought global growth would decline over the coming year, the highest proportion since polling began in 2011. Eurogroup chief Mashal Donoghue has told Bloomberg the euro area is in a, quote, very resilient place and is likely to avert recession albeit with a very low level of growth this year. EU Economy Commissioner Paolo Gentiloni, meanwhile, says inflation is past its peak.
I think we managed to reduce energy dependence. Energy prices went down significantly, and inflation peaked at the end of last year in Europe. So there is a chance to avoid a deep recession and maybe to enter a more limited, shallow contraction.
China's economy grew at the second slowest pace since the 1970s last year, but fourth quarter data were better than economists had expected. GDP growth slowed to 3% in 2022 as the country doubled down on its now abandoned COVID zero policy. Growth slumped from 8.4% in the previous year. The UK government has blocked transgender rights legislation passed by the Scottish Parliament, setting up a major constitutional row. Westminster says the law would have an adverse impact on UK-wide equalities legislation. It is the first time the UK has blocked any legislation passed by the Scottish Parliament since it was formed in 1999. Global News, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Now, Saudi Arabia's economy and planning minister told Bloomberg that he is confident the country can attract enough large-scale investments to diversify the economy away from oil. Faisal Ali Ibrahim spoke exclusively to my colleague, Manus Krani, in Davos. Take a listen.
Saudi Arabia is today, without a doubt, the global growth story. And when we look beyond the actual GDP numbers, we're expecting 8.5 for the last year, 3.1. The World Bank is expecting 3.7% GDP growth. What we care about is actually our non-oil GDP growth, our non-oil activities, and how much we detach from oil. So we're steadfast in our transformation. We have the fiscal discipline. We have the economic transformation tools, and we're moving forward with them.
Let's talk a little bit more about the private sector, because you've rolled the dice on Lucid and Foxconn. From where I sit, two massive moments for you in EV and in tech. Is that the key focus, or does it have to be another Lucid deal, another Foxconn deal, size?
We need to keep in mind that we're doing these deals because they're important for our economic transformation. They'll help us diversify the economy and help us export more competitively. Now, these two deals are just examples of what's going on, and they're not really just about EVs. They're about the whole ecosystem that comes with EVs and technology. We're making bets for the future and for the green future as well.
Any more news with Foxconn? Anything additional to whet my appetite?
We continue our discussions with these partners and other partners, and anything coming soon will be announced.
Who are the others? You can't throw others in and then not just sort of elaborate. A little bit more on that.
I can tell you we're very serious about our diversification efforts. So we're open and we're talking to all partners who are interested in the Saudi story. The Saudi growth story is a global one.
The other dynamic for where you are geographically is how much do you think Saudi benefits from this onshoring, friendshoring, this movement of supply chains away from China?
Well, I think the kingdom is always seeking leveraging its unique position. The kingdom is essentially at the intersection of the world. So whatever there's opportunities that the kingdom and having operations and investments in the kingdom can be beneficial for these partners as they're evaluating or reevaluating their positioning, and for the kingdom, we'll take that seriously. The kingdom has access to natural resources, but also access to carbon removal technology, and is very serious about it. Access to a young population that's below 60% of which is below the age of 30. So many enablers that can attract a lot of partners.
That was the Saudi Economy and Planning Minister Faisal Ali Ibrahim speaking exclusively to Bloomberg about the kingdom's year ahead. It has, of course, been a busy morning at Davos, where the world's decision makers and market movers are converging for the first winter gathering since the pandemic disruptions. Our chief international correspondent for Southeast Asia, Haslinda Arman, is on the ground in Davos, and she is joined by an important guest. Good morning, Haslinda.
Hey, Tom, good to see you. And I'm joined by Paul Chan, by the way, a man you know very well. He's the financial secretary of Hong Kong. Of course, Hong Kong has just reopened its borders to China, to the rest of the world. Some saying that with that reopening, GDP will surpass that of Singapore for the first time in 15 years. Of course, Singapore, my city. Let's take that conversation with Paul Chan. He joins me here. Secretary Chan, good to have you with us.
Yeah, good morning.
With the reopening, there's so much optimism about Hong Kong's economy. I'm just wondering, in terms of momentum, what are you expecting? Are we looking at the momentum picking up in terms of weeks, in terms of quarters? What are you anticipating?
Well, we are very excited. We expect this year the Hong Kong economy will be rebound very strongly. Well, you know, with the reopening of borders, we have already seen visitors coming, and with the improvement in land transport with the mainland, exports will rise. Private consumption with the arrival of visitors will also rise. So that will help our tourism-related industries.
But how quickly will that happen?
It takes a little time for them to come.
What is that?
So the first quarter may be slower, but then I think it will pick up very fast.
What would it mean for Hong Kong assets, in particular the property sector? We've seen, of course, home sales slumping about 40% year on year. What kind of numbers are you anticipating now that, you know, the city has reopened?
Well, you know, last year, residential property price in Hong Kong came down orderly, I would say, dropped by about 13–40% in the first 11 months. But transaction volume did have come down as well, down by about 39% compared to the year before. Recently, we have seen signs of stabilization, no matter in terms of price or transaction volume. Actually, transaction volume become very firm. So, but at the same time, interest rate hikes has not finished yet. People is still a little cautious because external environment is still very challenging. So I expect the property market to stabilize. Yeah.
Do you see pent-up demand? Of course, this is a market that's known to have a very hot property sector. And what indications are you looking out for to perhaps prompt you to introduce measures to rein in prices?
Well, I don't think we need to do anything in this stage. Actually, last year, the volume came down because buyers are very cautious. Interest rate hike has not finished yet, and the economic situation is not particularly good. But this year, looking at the stock held by the various developers, completed units available for sale is standing at about 17,000. Which is quite high. And they are able also to pre-sell those have not been completed. So although the transaction volume will pick up, I don't think there will be will be an imbalance between demand and supply situation.
Might 2024 then be a different picture for you?
Well, you know, the world is changing very fast. We have to remain vigilant and monitor the market and external environments very carefully. At the end of the day, the decision to buy a property is a combination of different factors: interest rates, employment situation, economic situation, income situation. So I think this year, 2023, we are optimistic. In the next 2–3 years, we have to remain very vigilant.
Secretary Chan, you're currently formulating the next budget. What will be your priority? Will you be continuing with those cash vouchers to perhaps prop up the economy?
Well, the coming budget is really challenging, a very delicate balancing act. At the one time, although the economy improved, unemployment situation is stabilized at about 3.7–3.8%, but for a large number of grassroots citizens, their life is still tough, pretty stressful. But on the other hand, the government has registered significant annual fiscal deficit. So we have to balance our books. And more importantly, apart from looking at the short term, the present, we need to invest into the future. So one of my key priorities is to invest in areas that will power our economy, power our rebound.
What would that mean? Are you looking at big infrastructure projects? What exactly would that be?
Well, infrastructure projects, we have railways, we have roads. We are contemplating reclamation in central waters and undertaking projects in the northern metropolis. So this expenditure will continue to grow. Public public works expenditure, I expect to be exceeding 100 billion in the coming few years. But on the other hand, we need to invest in innovation and technologies. We try to attract strategic enterprises coming to Hong Kong. We stand ready to tailor-make packages for them, including concessionary land grant, financial incentive, as well as co-investment opportunities. I've set aside 30 billion Hong Kong dollars for these purposes. And we are attracting talents from all over the world to come to Hong Kong to work. Very aggressive strategies. Those talents, say for example, graduated from the top 100 universities, regardless of discipline, if they have 3 years or more experience, feel free to come. No need to get a job offer beforehand.
I want to touch on the IPO market. Of course, 2022 was the worst year since the financial crisis.
Yeah.
Are you optimistic that will pick up, and where will IPO demand come from? Will it be mainly from China or domestic companies?
Well, you know, last year was tough globally. And for the first 10 months, the market dropped significantly, affecting the valuations, thereby affecting IPO interests. But the market picked up very fast in November and December. November alone, bounced back by about 26%. This year, I'm optimistic because, you know, there is a recent announcement by the CSRC saying that international companies listed on our stock exchange can be included in the southbound. So for those companies, they can access international and mainland capital, increase liquidities, providing additional support to their valuations. So our objective is, other than on top of mainland companies, we need to attract more international companies, particularly companies from ASEAN, the Middle East. This is our prime target.
And to that end, you've been seeking an IPO by Saudi Aramco. That failed in 2016, 2018. Are you optimistic you can get Saudi Aramco to IPO in Hong Kong?
Well, there are a great number of Middle East companies that are of great potential. Recently, I visited Riyadh and Bahrain. Very exciting opportunities. So we are casting our net very wise. Hope to attract more to come.
Saudi Aramco this year, perhaps? Next year?
Yeah, we never give up.
Paul Chan, we thank you so much for your time.
Thank
Paul
you.
Chan, of course, Hong Kong's Financial Secretary. Tom, handing it back to you.
Fantastic stuff, Fazinder. Stay warm. Thank you very much indeed. Optimistic there, the Financial Secretary of Hong Kong, on the prospects for that economy this year. Now, coming up, everyone, of course, watching the BOJ, the big potential risk event of the week, and its policy decision tomorrow. We're going to get the rundown of everything you need to know. That is up next. This is Bloomberg.
Soaring energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Welcome back to the Open. 54 minutes into your European trading day. Losses of 0.1% across the broader benchmark here in Europe. A number of sectors, Joe, just eking out some gains. Basic resources at the top of the list, up 0.4%. The futures in the US, though, pointing lower by between 0.2 on the S&P E-minis and 0.4% for the Nasdaq futures. Here in Europe, the ECB's Philip Lane telling the Financial Times rates will need to move into restrictive territory. The pound is getting a bit of a bid as well on expectations that maybe the BOE will be compelled to hike once again next month. But from the BOE to the BOJ now, investors have their eyes locked on that BOJ decision tomorrow. The surprise move to widen the yield curve control band in December has flagged, of course, to markets that the central bank could further abandon its ultra-loose monetary policy. Joining us now from Tokyo, Paul Jackson, Bloomberg economy editor for Japan, Korea and Australia. Who better to get on to work through this conundrum for the BOJ? Paul, thanks for joining us. Will the BOJ then pull another surprise out of the hat tomorrow?
Well, that's the big question. I think what we should perhaps ask is, do central banks like to be bullied by markets? And I think the answer is no. So that should inform you the idea that if the BOJ can get away with not acting tomorrow, they will try to do so. The consensus, the base scenario of economists, is that the BOJ will stand pat and not do anything tomorrow. 42 out of 43 economists said that. But the conviction is much weaker than it was in December. Because, of course, what happened in December threw everything into array. To what level can we believe the BOJ signalling and messaging on policy? We can't. The surprise is definitely, there's a risk of that. Now, in terms of reasons for not taking action, it seems too soon. If they act in January after acting in December, one former BOJ official, Hayakawa, said it would be embarrassing for Kuroda to act so soon. It would suggest they didn't do enough to sort out problems in December. Also, there's been market pressure pushing the yield above its new cap. Yeah. And the BOJ has been spending trillions of yen to bring it down to 0.5, but that pressure has also weakened a little bit. So what are the reasons for acting? Well, I guess the problem is the liquidity that they said was poor in December is even worse now. The kink in the yield curve is even more pronounced than it was in December. If they're trying to smooth that out, it's certainly not worked there. So there are reasons for taking action.
Paul, we're running short of time, but we appreciate the insights ahead of that BOJ decision. Paul Jackson from Bloomberg, of course, in Tokyo. Stay with us. This is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes, I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacroix, live from Davos. Now, it is a blockbuster show today. Out from the World Economic Forum, we'll be joined by 3 big guests. In 10 minutes, Manus Krani interviews the OPEC Secretary General. Then at 1:30, we'll also speak to the German Economy Minister, Robert Habeck, followed by the Credit Suisse Chair, Axel Lehmann. But first thing is first, let's check in on the markets with our Danny Berger. Hi, Danny, what do you have?
Hi, Francine. Well, I gotta say, some of the conversations you've been having, Philip Hildebrand comes to mind, warning that this market is too optimistic about a lack of rate hikes or cuts, seems to be filtering through. We are looking at European stocks moving lower today, consolidating after reaching the highest level since April yesterday. One of the things that has been helping European stocks, though it's not today, is Nat Gas continues to move lower. It has lost about 20% in about 3 days, trading at its lowest since 2021, thanks to increased stockpiles in Europe. Finally, you are looking at rate bet hikes, changing those bets around the UK after wages came in for the region at a near record pace. That means we're seeing the currency, sterling, that's stronger against the dollar, up by about 0.2%. And we're looking at bond sell-off gilts. Those yields are higher by about 3 basis points. And that matches some of the action we're seeing both in the rest of Europe for sovereign bonds and U.S. Treasuries, where 10-year yields are higher by about 4.5 basis points, Francine.
Danny, thank you so much. Now, the UBS chief executive, Ralph Hammers, believes inflation will stay higher for longer. Well, he spoke to Manus Krani earlier here in Davos and explained why the Swiss lender aims to boost its U.S. business while also keeping a long view on China.
Just go back last year, the war, the sanctions, the energy crisis, supply chain still faltering. I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
The natural corollary to that is you as a house were way ahead on your call on China. You've reaffirmed it this morning. Is that movement from China, has that been reflected by the clients? Are they much more active in taking China risk?
Well, we've seen more activities, but we have certainly advised them to go long on China and to be overweight on China. That's what we came out with on time, I guess. I think we were all a bit surprised as to the speed at which China opened up, but I think. Advising the clients, and they really have come, and you know that from the third quarter, clients in periods like this need more and more advice. They really come to me. I'm talking to them. and they're saying, well, okay, help me reading these data, help me reading these trends. Where should we go? And basically, they put a lot of money with us to manage for them, right, in the third quarter.
And are you saying cash first, reflect, and wait for a pivot? Or are you saying actively deploy, but judiciously? Which is the narrative for you?
We're still cautious as to the balance that you bring. But there is moments to invest. There is absolutely moments to invest.
The other big debate is this: peak inflation, peak rates, and peak liquidity. Now, there's two bids there, and there's one offer. If I look at the inflation narrative, the consensus is building peak inflation, and it will drop precipitously. Are you expecting a precipitous drop in inflation?
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay. And there's a reason for that. If we truly look at what has happened to us in the world over the last 3 years, we do think that we're going into the era of security. It's energy security, it is about food security, it's about technology security. For that, part of the supply chains that we are still dependent on will have to be rolled back, which basically means you bring labor back, you have to invest. The energy transition is still at its infancy, at its start. Lots of investments will have to go into becoming less dependent on energy from other countries. So I do think that inflation will be higher than what we are used to in the past. So it will not come down to the 2% that we are used to. So we'll have to work with that, but it will decrease from here.
Well, that was the UBS Chief Executive Officer, Ralph Hammers. Now, stay with us for a big day of interviews at the World Economic Forum in Davos. Amongst our other guests today, we'll also be hearing from Ferdinand Marcos Jr., the President of the Philippines, plus the OPEC Secretary General, Haitham Al-Ghais. Now, don't miss our interview, exclusive interview with the German Chancellor, Olaf Scholz. Bloomberg's Editor-in-Chief, John Micklethwaite, will bring us that interview live, so stay tuned for that. Now, let's also get to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. The World Economic Forum's annual meeting is underway in Davos, with corporate executives and economists warning a global recession is likely this year. A PwC survey of business leaders late last year found 73% thought global growth would decline over the coming year. That's the highest proportion since polling did begin back in 2011. Eurogroup Chief Pascal Donoghue has told Bloomberg the euro area is in a very resilient place and is likely to avert a recession, albeit with a very low level of growth this year. EU Economy Commissioner Paolo Gentiloni, meanwhile, says inflation is past its peak.
I think we managed to reduce energy dependence. Energy prices went down significantly, and inflation peaked at the end of last year in Europe. So there is a chance to avoid a deep recession and maybe to enter a more limited, shallow contraction.
Now, China's economy grew at the second slowest pace since the 1970s last year, but fourth quarter data was better than economists had actually expected. GDP growth slowed to 3% in 2022 as the country doubled down on its now abandoned COVID-zero policy. Growth slumped from 8.4%, and that was in the previous year. Now, U.S. Treasury Secretary Janet Yellen will hold her first face-to-face meeting with Chinese Vice President Liu He in Zurich. That's happening tomorrow. Beijing says the talks are aimed at strengthening economic and also financial policy coordination. The announcement follows a November meeting between Presidents Joe Biden and Xi Jinping on the sidelines of the G20 in Bali. The UK government has blocked transgender rights legislation passed by the Scottish Parliament, setting up a major constitutional row. Westminster says the law would have an adverse impact on UK-wide equalities legislation. It's the first time the UK has actually blocked any legislation passed by the Scottish Parliament since it was formed back in 1999. China's population fell last year for the first time since 1961. According to official stats, there were 1.4 billion people at the end of last year, 850,000 fewer than a year previously. A drop in the number of births to its lowest level since 1950 was the biggest contributor to the overall change. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. We're just getting also some breaking news from that German defense minister story. Yesterday, we saw that, of course, there was a resignation. Now, Boris Pistorius will be named German defense minister. Of course, this is according to the Spiegel. We need full confirmation from the government, but it will certainly put Germany at a better footing as they deal into negotiations on a number of factors with Ukraine. It's always very difficult to be taken seriously and to be able to negotiate thoroughly if you're lacking the proper minister. So we now have that whole filled. Coming up, we speak with the OPEC Secretary General, Haitham Al-Ghais, live from Davos. This is Bloomberg.
China's appetite for energy is enormous. The country consumes about a quarter of the world's energy supply, 35% more than the US annually. Its energy needs have more than tripled since the year 2000. That consumption has helped to fuel astonishing growth, but it's come at a cost.
China is the world's largest greenhouse gas emitter. There is no way to tackle climate change unless China reduces its emissions to net zero.
The country's reliance on fossil fuels is also a hindrance to its own growth and the well-being of its citizens.
China is not energy secure. It has a massive import bill for things like oil and gas. It has a long-standing pollution problem, and it is also prone to outages that severely hamper industry.
All this has led the world's biggest polluter to take steps towards a radical transformation.
News breaks. No one covers the world like Bloomberg.
In addition to him pleading not guilty, as we had expected, to 8 criminal counts here, there was a lot else that happened.
1 million people are getting infected every day, and that's going to rise to 3.7 million by January.
The UK is the only G7 economy that hasn't returned to its pre-pandemic level yet.
Bloomberg, your global business authority.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. Good morning to our viewers and listeners of radio worldwide. I'm Francine Lacqua here in Davos. Now, we're back here in Davos, where the world elite are gathering for the World Economic Forum's annual meeting, the first one in 3 years where we're in the snow. Let's get out to Manus Krani, who's there talking oil with the very special guest. Manus.
Francine, thank you very much. A very good day to you. Joining me here on the rooftop, it is Secretary General for OPEC, Haitham Al-Ghais. It's my first Davos. I think it's yours as well, officially for WEF. So we can both put our stamp on this. Everybody's debating the world economy. From the data you look at, are we flashing amber, red, or is there a hint of green in the global economy?
First of all, Manus, thank you for hosting me. Indeed, it's my first Davos, and delighted to be with you first on Bloomberg TV. Wishing you a happy new year. We came into this year, as you recall, back in the fourth quarter with growing signs of recession, global slowdown in economic growth, signs of China closing down. Nobody knew what that would look like, what it would lead to. I think now we're still too early into the new year to determine exactly if it's going to be amber, green, or red. But we're seeing signs of green. I must say, however, we are always cautiously optimistic. We have been I have personally said this to you before in our previous interviews, we've been always very bullish on China.
Yep.
China is a big economic powerhouse, has significant implications for global oil demand. And we saw what happened when China closed down. Now everybody is optimistic about China opening up. So I say, yes, we are optimistic, but again, we are cautiously optimistic. We have to see what happens when the Lunar New Year takes place in a few days. What that means, the travel now is booming domestically, but also China travel could boom internationally.
There is a tail risk that after the Lunar New Year, we get another spike in COVID, which could unseat all of our optimism. But run me through your fully more optimistic, full throttle China, full reopen. What will it mean for demand for oil?
Well, we're going to issue our new monthly report, the first report of this year, 2023. We see demand rising in China. We've been, again, even with all the slowdown we were forecasting before, we have seen Chinese demand predicting that it's going to grow by around approximately 500,000 barrels a day this year. And we're seeing different views, different numbers, but again, it's a bit too early to say exactly what will happen. We're seeing also signs and news about bigger Chinese crude import quotas being given by the government, which is a good signal that China's buying is going to pick up again as we get through the first quarter.
So moderate cautious, Secretary General, is my first take from those couple of answers. You're preemptive, you're proactive. That is the byline of OPEC+. So the case, as we go to the JMMC in February, from this caution that you're giving me, is the case building for a deeper cut?
Well, again, it's very premature to say we have to meet and review everything. We're only into the second week, basically just starting into the third week of this year. A lot of moving factors, moving elements. We can't really jump to a conclusion from now and say what we will come up with. The JMMC, however, has a clear mandate to observe, to monitor, and to be quick and vigilant in calling the ministers for whatever is necessary. Whenever we require to call for a ministerial conference, we are watching so many moving parts at the same time, China just being one of them.
And I think it's good that you pull me back from that over-bullish position. The first 2 weeks of the year, we need to reflect on the data. But let's project forward. You've got 500,000 barrels a day for China. Let's say things go well, things open up full Monty. Do you see, because we talked about this, do you see a deficit in the oil market in the second half of the year in that scenario?
Well, there's a balance we have to look at as well in the market. We can't just isolate China from the rest of what we see in the oil markets. I mean, we're talking about a slowdown in Europe. We're talking about a slowdown in the US potentially. Still, there's the element of inflation that's being combated and targeted by central banks around the world, especially in the West. So we have a tale also of two different markets. One potentially where the advanced economies could continue to slow down.
Do you think full recession for the advanced economies?
Slow down into potentially recession. Some people already saying we are in parts of the world in recession, in Europe, for example. And the other part of the market we see is China and potentially Asia, Middle East, India, all picking up. So we have to balance the two, and we cannot really come to a clear conclusion as of yet. I think by February, March, after Lunar New Year is over, after we push through a couple of months into the new year, things will become more evident and more clear.
What could cause OPEC Plus to unwind the 2 million barrel a day cut? When I came to Vienna, it was announced. We were all summoned, and you had the big headline. What could cause OPEC Plus to step back from that 2 million barrel a day cut?
We are always looking at everything in the market, Manas, and we've said this repeatedly. There's many fluid factors moving along at the same time.
Okay.
There is demand, there's supply, there's a potential risk of recession. Whatever it takes to manage the market and keep it stable, we will do. But we have to not preempt and not be overly judgmental at this stage of what may happen.
The other side of this trade is the plus. Russia, the dominant supplier. Novak has made it clear that he's prepared to slash production by 500 to 700,000. He says that that is insignificant. Is that insignificant if Russia, they haven't done it yet, 500, 700,000 barrels a day, is that insignificant?
Well, nothing is insignificant in my perspective. I mean, 500,000 barrels a day is big. Russia is a big producer. They produce over 10 million barrels a day, one of the biggest producers in the world. But again, this is only part of the equation. We have to look at it holistically.
How would OPEC Plus react to a material loss like that?
Again, it's premature. I think we would have to really see it. I can't really predict what would happen, but we have to look at the overall global balance. It's not just Russia. We have U.S. production rising. We have production rising from Brazil, Canada, Guyana. OPEC Plus, we have now spare capacity thanks to our decision we took back in October. So there are a lot of moving elements, and you couple that with what's happening and the demand side risks we are talking about. There's a lot to look at.
We're here in the cold and the ice. You talked about a thin buffer and balance of spare capacity. I presume it's getting thinner. How thin is the spare capacity now? Are we breaking spare capacity?
Well, actually, to the contrary. I mean, after our OPEC, after the October decision where we agreed to adjust production downward, we now have more spare capacity. And this is something that the market was worried about all the time. But I also want to take this around to the issue of investment. I mean, when we talk about spare capacity, again, we've cautioned and we've repeatedly called for more investments in order to have that spare capacity that everybody is concerned about. We in OPEC are doing our part. It's a holistic view again. It's not just in the upstream. I mean, we talk about the medium to long-term outlook. We're talking till 2045. The oil industry alone needs $12.1 trillion of investments. This is significant. We're already falling behind. We've said this before. We need today to invest just to keep production at current levels, let alone cater for additional demand, which we see rising by at least 10 million barrels a day by 2045.
Well, let's hope the banks have the thirst to lend appropriately on fossil fuels and beyond. Secretary General, great to have you with me this morning.
Thank you, Alice.
And good to break a bit of ice together on Davos. Francine Lacroix, good morning.
There you go, your first Davos, and you're already moving markets. Manus, great interview with the OPEC Secretary General, of course, on the latest with the oil outlook, with also price range that we could be looking at. Now, Marsh McLennan is one of the world's largest consulting firms and insurance brokers operating in more than 130 countries. So with us now is John Doyle. He's the Chief Executive Officer of Marsh McLennan. Thank you so much for joining us.
It's great to be with you,
Francine.
Francine.
There's so much to talk about. First of all, are you more or less optimistic about 2023 than you were of 2022?
I'm excited about 2023. There's a lot in front of us for our business. We're, it's 85,000 people strong, advising clients and governments around risk strategy and people. And there are a lot of issues to confront. We just published, of course, the Global Risk Report in conjunction with the World Economic Forum. And there's a lot to confront. And so it's a big opportunity for us as a business.
And if you survey chief executives, they're worried about the future. It's not necessarily a recession, but certainly a big slowdown. What will that look like? What are the winners? Who are the winners of this recession?
Well, it's complicated, of course. There'll be lots of winners and losers in this kind of market. But they're worried about inflation. They're worried about energy supply. Of course, they're worried about extreme weather events, geopolitical uncertainty. So there's a lot to confront, and we're helping businesses and governments confront those issues all around the world.
What's the question that you get most often from chief executives?
Oh, I think the economy. Everyone's worried about the risks of a recession, and not just a mild recession, but a hard landing, later in the year. And things look okay right now, but it's quite obvious that central banks' top priority is tamping down inflation, and that's going to have an impact.
So, John, do you worry actually that we haven't seen more companies go under and that it will all come at the forefront? I mean, it's pretty incredible to go from 0 interest rates to 3, in certain cases 4%, without damage to businesses.
Yeah, look, I think we've learned a lot from events over the course of the last couple of decades. So banks, of course, are far more resilient than they were in the past. So there are credit risks in front of us for sure, but I think we'll be able to navigate it reasonably well. So I expect an impact to the economy for sure, but maybe even a mild recession likely. But I think we'll be able to navigate it okay.
So navigate how? Again, who will win the most? If you look at the sectors and industries that you advise.
Well, we're helping clients become more resilient. And, it's not just the current economic conditions, but learning from the great financial crisis, learning, of course, from the all the issues that we confronted in the pandemic. Businesses and governments are trying to better balance resilience as opposed to finding great efficiency.
Where do you see the most efficiency? So we're seeing a number of sectors, cost cutting, margin earnings were actually okay last year.
Yeah.
What's it looking like in 2023?
Yeah, and it's early, of course, in the fourth quarter earnings seasons, but I suspect in most major markets earnings will be okay.
John, overall, what is the one we look at some of the pitfalls and some also of the bond issuance? There's something that really caught our eye, which is the first cyber catastrophe bond sold in London last week. What does that tell us about the future?
Well, the risks of a digital economy are certainly very much on the mind of business and government leaders all over. And certainly the war in Ukraine created some even greater awareness of all these risks. And so that's an important development in the insurance markets and one we're incredibly supportive of. We need to bring more investors to the game to really deal with tail risks in cyber.
John, thank you so much for joining us today. That was John Doyle, Chief Executive Officer of Marsh McLennan. We'll get you a warm drink because it's so cold out here. Danny, what are the markets looking like today?
Francine, it continues to be a down session for this equity market. Of course, I feel guilty because I'm telling you this from a very cozy, warm studio. But yes, European stocks down about 1/3%. Nearly every single industry in the Europe Stock 600 is down lower this morning, save for energy and ever so slightly basic resources. This comes off the back of a Goldman Sachs call for a bullish concoction for the commodity market this year, given China reopening, given that tight supply. However, one commodity that Goldman points out that tight supply isn't necessarily holding true is for nat gas. Nat gas prices, those continue to drop another 5% this morning. It's been really remarkable to watch in the past 3 days for nat gas. Those are Dutch front month futures there, dropping 20%. Now, it's not just that Europe has done a good job curbing demand, especially given the weather is more mild, although, of course, it is turning cold now. It really has to do with supply. We've seen a lot of the LNG supply from Asia, from China, get rerouted into Europe. So those higher stockpiles mean that prices have been able to fall to their lowest since September 2021. Now, does that change when China comes back online, when the demand starts to grow? Only time will tell there. Meanwhile, UK assets seem to be preparing for more of a rate hike after hot UK wages. Francine.
Thank you so much, Danny. So we look at the markets. Really, the conversation here is also on rebuilding Ukraine at the forefront of all geopolitical tensions. One of the panels that I'm most looking forward to is, of course, understanding the way forward for this country, some of the support also that's given by the West, and how much this will cost and also how much this will last. So I'm delighted now to be joined by Yulia Sigadenko. She's Ukraine's economy minister. Minister, thank you for joining us.
Thank you.
It's really a great honor to understand through your eyes what the economy is going through. Of course, we always think of the loss of life and everything that your country is going through, but how much in terms of economic support do you need to start to rebuild the country? Is it too soon to talk about that?
Okay, so actually the fall of Ukrainian economy in the last year was about 30.2%. So actually our prediction were even worse at the beginning of the war. So we estimated that it might be up to 50% of GDP lost by the end of the year. But it's 30.2, and we hope that this year is going to be the year of the early recovery, and it would be the year of the small growth of Ukrainian economy. Of course, you understand perfectly well that everything depends on the military situation,
of course,
and on military scenario. Yes. That's why even in Davos, during the economic forum, we will be focused in our discussion on military support, first of all, and on a peace formula that was launched by President Zelensky during the G20 meeting. So,
but, Minister, there's, of course, a legitimate reason to ask for money or cash, for example, for the farmers that are slowed, that need to continue doing the crops. So what kind of support are you getting on that level? And the more the missiles strike, the less you have infrastructure, and so, of course, the more money you need.
Yes, so if we speak about the covering of the budget deficit, so we need $37 billion, and we understand that that money will go from EU support, and we are very grateful, and from of course, United States, and we hope that we are going to be the part of the full pledge program of International Monetary Fund. Right. So it's about covering the budget deficit, and of course, a big attention it's running Ukrainian business, how to run Ukrainian business, how to make Ukrainian business operate. So that's why we would like to focus on providing the insurance from our partner side to set up business and restoring. And of course, you're absolutely right. During the missiles attacks on energy grid, now we essentially need generator, transformator, everything that makes our system works.
But Minister, and I understand maybe this comes second, but some of the risk insurance instruments, when do you think they'll be available for businesses?
So MIGA and DFC, MIGA is a part of the World Bank, and DFC are already ready to provide us with the insurance program for a foreign business and Ukrainian business that would like to set a business or to participate in recovery during this early stage of recovery, I mean, during the wartime. So they are able to cover 90%, and now we're just discussing about the interest rate, but I think that we will be able by the end of this month to finalize the product for our partners. So we will be able to provide this, let's say, like financial ecosystem that will give the understanding where exactly foreign companies should go to take this insurance, so to ensure themselves to start the reconstruction, because for us it's essential not to wait until the war will be finished and to start now, because we need to find a way how to return Ukrainians back to Ukraine, because it's our muscles, it's our brains, and we need them we need them back, and they want to return back. So that's why, together with partners here, we would like to work out tools for Ukrainian business and for foreign business, as we understand that foreign investment is going to be the core of reconstruction. That's why we need to find solution how to facilitate them to enter the Ukrainian market even now.
Minister, thank you so much for giving a little bit of your incredible busy schedule to Bloomberg. That was Ukraine's Economy Minister, Yulia Shiradenko. Now, South Africa's president has cancelled his trip to the World Economic Forum this year for emergency talks with state power utility Eskom, as the nation's rolling blackouts threaten to further weigh on economic activity. But the nation's finance minister told me about the company's balance sheet and just how much Eskom debt that the government can take on.
Eskom should be able to find ways of raising money to pay for diesel. So that's not, in my view, a major problem. So I've outlined 4 things that need to be done as a matter of urgency. One of the key points is not only to focus on diesel, is to focus on the 48,000 megawatt capacity which Eskom has, which unfortunately is coal-related, is to bring that power back.
Minister, how much of the debt will you assume?
We said in the medium-term budget policy statement in October that there are a lot of variables which will influence how much of that debt we're going to take over, one of which was the pronouncement by NERSA. We wanted to know how much are they going to give increase to Eskom, which will influence Eskom's cash flow moving forward. That has happened, and now we're working on the figure we'll be announcing on the 22nd of February.
2/3?
I said between 1/3 and 2/3 then. But now we're working on the exact figure, which we'll announce next month on the 22nd of February.
But can you give us an indication? Would it be below 2/3?
No.
Give me a price range.
No.
A range that's wide enough not to get you in trouble, but for investors to understand.
Between 1 and 2/3, I'm beginning to narrow the range because of just this last week getting Eskom's NERSA's increase, which will begin to help me to narrow the range. I can't narrow it at the moment.
Is it narrowed at the high end? Is it narrowed at the high end or the
Wait
top
for
range?
that on the 22nd of February next month.
But Minister, so after you announce it, how quickly can you then deal with it?
Even those modalities will be part of that announcement.
Can you tell me if it's brief or whether we need to wait much longer? Again, broadly, what kind of timeline? Is it 2 months? Can it take longer? How fast?
You know, I've got to take a number of factors into account. How much does it, what implications would it do on the debt to GDP ratio and so on? How do I stabilize that debt ratio over the longer term? Those are the factors I've got to take into account.
South Africa Finance Minister Enoch Godongwana there speaking to us in Davos. Now, we continue, of course, our World Economic Forum coverage here in Switzerland. Joining us now, Axel Lehmann, the chairman of Credit Suisse. Thank you for joining us. It's a great pleasure to speak to you. We're just on a panel together looking at the possibility of recession and, of course, all the pitfalls. You mentioned geopolitics and some of the tensions there. Do you think Europe will be on a better footing in 2023 than it was last year?
I hope so. I hope so. Yes, I believe so. On Europe, on the positive side, what you see, I mean, it's amazing. You know, the whole energy supply from Russia is basically breaking up, falling away. But Europe seems to cope with it. Yeah. Yes, but Europe will be a hard time. Energy cost for Europe will be the highest globally for many years to come, and that is a competitive issue for the European industry.
What does that mean for your client base? So I know you've had issues with outflows. Is it easier now? Have you been able to, tell clients to come back?
Yeah, it's interesting to see, people are really watching carefully. Inflation is the topic of Davos, the topic of the day, but when you peel back the onion, a multipolar world is coming with, the East partially decoupling slightly from the West. We have China, India, US, Middle East, huge growth opportunities. So people try to redirect their investments. There's plenty of money, plenty of resources, plenty of appetite, and they are looking to drive innovation and find the next wave.
How are your client inflows going? So are we in a better place? We spoke in London, and again, it felt like a turning point for the bank.
Yes.
Where are we now?
Obviously, we had that social media storm. I don't want to go back to that. Horrible, the outflows. It has basically stopped, dribbling out. It's slightly coming back. So that is very positive to see, and I'm rather, optimistic for the remainder of the year. It's still early days, so it depends all where the global economy is going. But the clients standing by, they want to do business, they want to invest.
What are bonuses looking like for your employees?
Well, we will communicate that, in due time. Obviously, we had such a poor year. There was a horrifying year for Credit Suisse. So I think people have realistic expectations that it will not look great.
I mean, will there be also compensation, related issues for the board? Are there cuts coming or things like that?
We look into very, very carefully. On one hand, you have that topic of retention, and then look, we have plenty of parts of the group that is doing extremely well. So you need to compensate somewhat fairly, but you obviously need to look also at the shareholder perspective. You suffer huge losses. That is clear that the budget get cut also on bonuses.
So the board compensation is on the table. It's something that you're, I imagine, looking at as well.
We look to everything from executive board, employee compensation, of course.
Talk to me a little bit about Credit Suisse First Boston. Where are we on that?
Well, I know this is an idea, strategy that creates a lot of excitement. We will obviously get much more into detail. I would expect around, the fourth quarter results release on beginning of February. But we will execute on the plan. We said it's, to put it partially in a separate unit. It will be more a partnership-led model. We are looking, and we have a great interest for third-party investors that would like to join. Yeah. We will reshape our leverage finance business. So there are lots of elements. Yeah. We bring it all together, and then we will inform the market.
Okay, so you're confident that you'll get an anchor investor. You're close to finding an anchor investor.
I'm really confident. I'm confident in the plans. I see also confidence when I see the speed of execution. We are putting now various puzzle stones together, and we'll then have a first communication in a more comprehensive way to the market.
Okay, Axel Lehmann, thank you so much for joining us. I can't believe you're not wearing a coat. This is like the difference of when you're Nordic and when you're Mediterranean, because I'm freezing. But you're fine, Axel Lehmann, the chairman of Credit Suisse there. Now, coming up, we'll have plenty more from Davos, from the World Economic Forum. Don't miss our interview also with Saudi Arabia's finance minister, Mohammed El Jadaan. That's next, and this is Bloomberg.
COVID has changed everything. People are changing the way they work and the way they travel. Can you explain what you mean?
I think the world is never going back to the way it was fully before the pandemic. And one of the changes I think, David, has been a change in how we work. Many people had a job at an office. They're not going to be required to come back to the office 5 days a week. And I don't think CEOs per se are going to determine these policies. I think workers will, because all of us CEOs, I think, want the best talent. And I think flexibility is going to be the second most important benefit after compensation. All of this, David, has culminated in Airbnb not just being a company about traveling, but now a company about living. So there's this whole new category of travel that's not classic 2-3 nights in a city. It's not long-term housing, and it's completely emerged because of the pandemic.
Season is here.
Wall Street expecting a bit of an ugly season.
People may be overly pessimistic.
We know growth is slowing.
Companies are going to have a lot of questions to answer.
Bloomberg breaks the numbers first.
Tons of banks coming out.
Some of the worst returns when it came to profit. Markets really like that number.
With exclusive expert analysis.
What's your confidence in your outlook?
You got to be selective.
We still see a lot of opportunity.
There is a light at the end of the tunnel.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in Davos. Now, we're live, of course, at the World Economic Forum 2023. The global elite are back for the first time in 3 years, and with some great interviews. Also, Isman is speaking with the Saudi finance minister. Manas, over to you.
Francine, thank you very much. Very good morning. Mr. Al-Jadaan joins me, Minister for Finance for Saudi Arabia. Welcome to Davos. Welcome to Bloomberg.
Thank you.
Let's start global. I mean, you provide the oil to the engine of the world, to China. The reopening is accelerating faster, I think, than anybody ever presumed. What are the ramifications for the world and for Saudi?
Thank you very much for having me first, and it's good to be in Davos again. I think the world is going through a lot of issues, and, energy security is one, geopolitical tensions, inflation, a lot of things that will need really to be attended to, and Davos is one way of really having a dialogue. China is reopening. It is not a surprise. I think they had their zero COVID policy for some time, and now they realize that they need to open, which is good. I think it's good for the world economy to have China. It is good for the supply chain to have China back in action. On the energy side, what we are trying to do is trying to invest as much as we can, both in the conventional energy but on renewable energy, to make sure that the world is supplied with enough energy.
Does their reopening put a floor under the global economy?
I think it helps definitely to support the world economy. The world economy needs that support, and a lot of countries around the world are facing recession, so we need some support.
Where are you most worried about in terms of recession? Because the blowback takes a bit of a time to land on your shoulders in Saudi and mine in the Emirates. Where are you most worried about globally?
I'm worried really about the most vulnerable nations, most vulnerable countries, low-income countries. Their debt vulnerabilities is really, really serious. We are seeing defaults, and we are likely to see even more defaults. And we need to work with multilateral institutions to make sure that we find solutions. And Saudi, during the G20 presidency, put forward the DSSSI and the common framework to help try restructure the low-income countries' debt.
Debt vulnerability and defaults, I mean, those are big words. Do we face a global risk of a major default this year, do you think?
I think there will be serious risks in certain countries. It is not about really the spillover of the debt itself, but what it means. It means a lot of issues for the people in these countries, a lot of difficulties. They will not be able to deal with inflation. I mean, more than 10 countries are now paying more than 10% on their debt. How are they going to afford it?
And that is where the sustainability comes in. But with that comes regional policy with Pakistan, with Turkey, with Egypt. I want to drill into Pakistan. A huge outreach, I would say, to deliver stability to some of those vulnerable countries that are at risk on the debt side. Where are we with Pakistan in terms of delivering more funds to the central bank to shore it up? You've put in 3. Will you raise that?
I think if you talk about the region, you need to talk, wider than Pakistan. I think there is Pakistan, there is other countries in the region that will need support, and Saudi Arabia have been in the first place to provide that support to the region. It is very important to bring stability. It's important to bring really more focus and even in reform and economic reform that will help these nations. We are working with multilateral institutions, with regional institutions to provide that support. Pakistan, Turkey, Egypt. I mean, we are providing a lot of support to Egypt and will continue to, not directly through just grants and deposits, but also through investments. We are investing heavily in these countries and will continue to look for opportunities to invest.
And are we right to say it is a $10 billion? I want to finish with Pakistan. Is the ambition to get to $5 billion in the central bank and $10 billion into the economy? Is that my takeaway?
I think the ambition is very clear. His Royal Highness, the Prime Minister, made it very clear last week that we are looking to invest $10 billion in Pakistan. We have a deposit that we have just signed an extension for. We are providing even oil and derivatives to support their energy needs. So there is a lot of efforts, but we wanted this to be collective. We are working with multilateral institutions, including the World Bank, to see how can we be more creative to provide that support.
Let's just pivot quickly back to China, because Xi visited Saudi Arabia, red carpet was rolled out. Was there a discussion around paying for oil in yuan? Fill or kill on this rumor?
Okay. Two things. One is we enjoy a very strategic relationship with China, and we enjoy that same strategic relationship with other nations, including the US, and we wanted to develop that with Europe and other countries who are willing and able to work with us to advance the public good in the world.
Yes.
I think with regard to China, they are the largest trading partner with Saudi Arabia. I think there are no issues with discussing how we settle our trade arrangements, whether it is the US dollar, whether it is the euro, whether it is the Saudi riyal or their currency.
There was no discussion on that at all?
I don't think we are waving away or ruling out any discussion that will help improve the trade around the world.
Let's close with this. Saudi first, it's made very clear by His Royal Highness Prince Abdulaziz bin Salman in his rhetoric. Saudi first, does that push you more towards China for your financial ties and relationships than it does to the US? Is a pivot in the making, and will it evolve more quickly than we think?
I don't think so at all. Actually, we are working with both. We have a lot of interest in our relationship with the US. Our rial is pegged to the US dollar. A lot of our economy is traded through US dollar with international partners. But we also look for China and advancing the relationship with China. We trade with them significantly. They are the largest trade partner with us. So we wanted to make sure that we bridge this global divide and provide ways to ensure that this fragmentation is contained and cooperation and collaboration is improved.
Minister Al-Jadaan, I wish we had more time. We could explore the regional policy a little bit more, but from a global perspective. Thank you so much for joining us here on Davos this morning. Francine.
Thank you so much, Manas. Now, we'll have plenty more, of course, throughout the day. That was Manas Kranian, Mohammed Al-Jadaan of Saudi Arabia. Now, let's also talk about other economies. We're now joined by Germany's Vice Chancellor and Minister for Economic Affairs and Climate Action. He's Robert Habeck. Minister Habeck, thank you for joining us. I mean, there's a lot going on, especially in Germany at the moment. Yesterday, we broke the news that your defense minister had resigned. Now, according to Bloomberg sources, Mr. Pistorius will be the new defense minister. Do you welcome that?
Well, it's not officially said, but it could well be, and yes, I welcome it. I know Boris Pistorius well from former jobs I had. He's a very experienced politician, very strong nerves. I think he's the right representative for the German army, and he will also be a man able to take strong decisions in short time, and this is what is needed.
And this is needed because, of course, there's war in Ukraine and decisions on tanks and things like that. What kind of new phase does that mean for Germany? Is there going to be more support for Ukraine, you think?
Well, we have given more and more support. So you see there's a dynamic from the German starting point before the war that we won't deliver weapons in zones of conflicts. We are now delivering all sorts of weapons, actually not all sorts of weapons, the heavy tanks we don't, but we always said that we will adjust our decisions in the line of the argument of our partners. This is mainly the US, but also the other partners. And you see Great Britain, Finland, Poland, they are willing now to bring tanks to Ukraine. First question is Germany, there are German tanks, or Great Britain not, but the Finnish and the Polish tanks, German tanks, we have to say yes to that. I argue that we will do that.
Yeah.
And,
this is for the Leopard battle tanks. Would you be in support in sending those?
Well, we haven't made a decision. If Germany gives own Leopard battle tanks to Ukraine, we will do this in line with the alliance. So if America would decide that they will bring battle tanks to Ukraine, that will make it easier for Germany. You know our history, and we are a little bit more reluctant there for understandable reasons. But
why reluctant? I mean, the reluctance also
because
really
of
came
our
from the
history
Chancellor.
bringing tanks and tanks fighting against Russia. But this is not my perspective. I think we adjusted our position many times over the last year, as every country has done, and Ukraine has proven that they are careful on the battlefield but successful. They need more weapons, and Putin is not seeing that he's making a big mistake. He's offering his population now, the men he's sending to the front, they are doomed to die, a lot of them, but still the war's ongoing and Ukraine needs more support, and this will be one of the first decisions the new Minister of Defense has to take.
Is there, Minister, a red line? I mean, we're also talking about possibly sending fighter jets. At some point, does this get taken as a declaration of war from Putin? Does he interpret it as actually we're now full on war?
Well, the red line must be always that we are not engaged in a third world war, that the war increases that much, that the US, that Europe, that Germany will be part of the conflict, meaning that we can't stop it anymore. So it must stay at the front, at the battlefield, Ukraine. But saying that means also that Ukraine must succeed. They have to win the war, and we have to give them all the military equipment that is needed to win the war. And now we're discussing the tank question.
Minister, talk to me about the economy. Are you surprised at how resilient the German economy has been? Despite the war, there was growth of 1.9% last year. Is this thanks to the mild winter, and do you think we'll avoid a recession?
We had 3 mild weeks, but before we had 3 tough weeks. So saying a mild winter, the average is a normal winter. I would say maybe a little bit more than the average due to global warming. I mean, also Davos has seen more snow, so there is some snow, but not that deep. So the world is becoming warmer, also Germany, of course. No, the difference that was made is that we were able to fill the storages and build up new infrastructure. The LNG terminals, we have now 3 in operation, and the third one is coming in next weekend in Brunsbüttel, a small German harbor near Hamburg. And this was done in 10 months' time. And this is the astonishing thing. So that we have, the crisis is not over, but we can handle the crisis. And in last summer, we really looked in the abyss.
Yes.
The threat of an economic meltdown of European economy was real.
So you think we can avoid a recession?
This is banned for the moment.
But can we avoid a recession, given the strength that we've had so far?
Well, recession technically means that you have periods with negative growth. And it could be that we just slip away from that, but this is not good enough, of course. That would always mean that we have stagflation, that we don't have a period of growth. And my experience, my idea of the next year is that we will face in the first quarter of the year a phase of the world economy where there's no growth, but in the end of the year, I think China will bounce back, and we will get to a new period of then hopefully sustainable and green growth.
Minister, do you think that Germany has overpaid for gas? So we've seen gas prices up, but you've paid more than they are now to stockpile. Was that the right decision still?
Well, yeah, it was the right decision, and yes, it was. We paid for high prices. In August, we tried to fill the storages, and therefore, of course, the 350 euros the megawatt hour we paid, then they were not sustainable. We destroyed the market in a way. This is true, but due to that, now the storages are full. Imagine the vice versa situation that we haven't done that. The prices in August would remain lower, but now the storages would be half empty. Then you would ask me, are you crazy? Why aren't the storages full? So I think, yes, it was a hard decision, and the prices were absolutely too high, but the result is that we now have low prices.
Does it mean though that
lower
contracts...
prices, they are not low actually, but they are now above, short above the price niveau before the war.
Would contracts going forward have to have clauses, I guess, to see whether it goes down, or is this the only way you win the war on gas against Putin?
Sorry, I haven't got it.
Do former, I know they're very, heads of state arriving. Is there, when you look at the contracts in the future for gas prices and how much you buy to stockpile, does it have to involve a clause where if they go down, you pay less?
Well, actually, we see that the markets are reacting, and and these are the most effective instruments. The markets bring the prices down as long as the markets are functioning. We had the period in last August where the markets were not properly functioning because we gave the sign we buy everything to every price. This was, as I've explained before, not healthy, but necessary in a way. And we should avoid this kind of period again, but if this would happen, then we should interfere in the markets.
Minister, do you believe that, Vladimir Putin lost the war on gas? He was using a lot of the commodities as a war against the West.
With Europe, he has lost it, yes. He made the wrong calculation. We are able to manage without Russian gas and oil and coal. For the world, of course, other countries are buying oil and gas from Russia, which is not helpful right now.
Minister, the other question, of course, is Europe really being up in arms about the Inflation Reduction Act in the U.S. How does this end? Is there going to be an agreement?
Up in arms is maybe a little bit too strong, because first I would like to say I really appreciate that the U.S. economy is moving into a green economy, that the government took the right decision saying global warming needs climate action, and now we are bringing all our financial force into climate neutral industries. But there were parts of the inflation, or there are parts of the Inflation Reduction Act that are problematic, that are not in line with WTO, that if Europe would answer with the same attitude, no, they should not. We learned in the last year, especially in the last year, that the transatlantic partnership is strong, that we are partners, and we should not be engaged in a trade war. But things are moving slowly, too slowly actually, but they are moving in the right direction. So there are changes in the interpretation of the IRA, and Europe also has to do its homework, and if both countries or both continents are doing their homework, then we will succeed.
Minister, thank you so much for joining us today. That was Minister Habeck, German Vice Chancellor on Economic Affairs and Climate Action Minister Robert Habeck. Coming up, we'll have plenty more, of course, from Bloomberg, and don't miss our exclusive interview. Our editor-in-chief will speak also to the German Chancellor Olaf Scholz. More Bloomberg Surveillance Early Edition your way from Davos. This is Bloomberg.
today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question. Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
I think we were all a bit surprised as to the speed at which China opened up energy need, commodity need in China. I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
I think that the medium-term potential for China's growth is still something where we do see it coming down.
Actually, we think that the Chinese economy is going to massively outpace the rest of the world as we go into the second half of 2023 and into 2024.
This is Bloomberg Surveillance, early edition with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. China's economy is proving more resilient than analysts expected in the face of the COVID outbreak. That's adding to the bullish case for commodities. It's a rare case of an activist targeting a prominent Chinese company. Meme stock investor Ryan Cohen takes a stake in Alibaba and wants the e-commerce giant to buy back more of its own shares. And Goldman Sachs and Morgan Stanley are out with fourth quarter earnings today. We'll see if they join their peers with a big drop in M&A fees. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. And Kaylee, welcome back to the American market, of course. Europe was up and trading, going nowhere busily yesterday. European equity markets losing their poise this morning in the face of a little bit of selling on US futures.
Yeah, and you didn't see much of a firm footing for stocks in Asia overnight either, Anna. It really was a wishy-washy day with not a lot of movement overall at the headline level for the MSCI Asia Pacific Index, which was very, very little changed. We're talking less than 0.1%, essentially flat on the day. You had gains in Japan offset by weakness in Hong Kong, and Chinese stocks were a little bit lower as well. Interesting, after we got Chinese GDP data out for the year 2022, 3% growth for the Chinese economy. That is the second slowest on records going back to the 1970s, but we did see better than expectations data for the fourth quarter and December specifically. So shows a little bit more resilience for the economy, even in the face of the virus outbreak that really was spurred by the releasing of COVID-0 policy. So that could set the stage for a recovery in the economy. Interesting, though, to see the Chinese yuan weakening against the dollar by about 0.6% to 678, and also weaker on the day, the Japanese yen, the dollar strengthening against the yen by about 0.2% to 128.78. But of course, in Japan, really, Matt, the focus is on the bond market as that 10-year JGB yield remains above that 50 basis point cap set by the BOJ. Right now, trading just over 52 basis points. Traders really betting we are going to see even more adjustment to yield curve control come that decision tomorrow, Matt.
Yeah, that is fascinating. Can't wait to see what the BOJ has to say. Here in the U.S., we have futures down about 0.33% this morning. We were higher on Friday in the cash trade, of course, no trading yesterday, but we've gotten back up to about 4,000. I think we closed at 39.99 on Friday, so we're up about 12% from the lows that we saw in October. Today, though, there are renewed concerns about growth out of China, and we have yields on government bonds really competing against stock yields. So 350, we're up another 5 basis points today as investors sell off the 10-year. We also see crude coming down a little bit, but at 79.59, we're right up against that $80 level. I actually had a dream about Jeff Curry. It was weird, but pitching investors that he's bullish commodities because the U.S. or central banks are maybe done raising rates or getting there, because Chinese growth is coming back. Hopefully, you know, it'll spur demand this year, and because if European economies grow faster than expected, those are all good things for commodities. Bitcoin at 21,167, we're back up to the high that we saw before the collapse of FTX. So before that November weekend that saw everything go down in flames and the price dropped to 16,000, now we're back up to 21,000 and change, and it's a real shift in terms of crypto sentiment. Of course, don't miss our program today at 1 p.m. New York time. Kaylee and I will lead Bloomberg Crypto.
Matt, I really wish my dreams were as constructive and as helpful to my day job. But anyway, this is what we see on European equity markets. European stocks making some modest losses today after modest gains yesterday, whilst Martin Luther King Day was taking place, of course, in the US, no trading there. So we've got European equity markets dropping back what they gained yesterday, pretty much. We've had some data just breaking, which underscores the change in sentiment we've seen for European assets, certainly from the start of this year. Germany, January ZEW investor expectations. So this is a survey of investors in Germany and what they expect to see in the future, and they have risen to 16.9, those expectations. The estimate was for -15, so we don't worry about what the numbers mean in themselves, but certainly that number much higher than had been estimated. It's positive, not negative, and so just a reflection of some of the turnaround in the German data that we've seen of late. And European expectations have been on a turn, and that's something I'll pick up in a moment. Let's go into the UK first. The UK two-year yield, rising yields here in the UK. We see this across a number of geographies, certainly here in Europe today, but the UK story getting a little bit more of that. We had wage data out today that showed historically very strong levels of wage growth, up by 6.4%. Another headache for the Bank of England. A lot of talk about whether we see another 50 from the BOE, despite the Fed dropping down to 25. Euro dollar at 108.14, pretty flat actually, but we heard from Philip Lane. He's talking about the need to get rates to restrictive territory. We heard from Mario Centino at the ECB. He was the one talking about how he's quite surprised also about the strength of the European economy. And here's one of the reasons we've seen that strength, of course, that big drop down that we've seen after that big spike up in gas prices here in Europe, down to the 54 euros a megawatt hour level. This is a drop of only 1.6% today, but I put it in here because yesterday European benchmark gas prices dropped by 14%, so a big drop yesterday, and we continue to build on that today. Credit Suisse down by just 1%. We heard from the chairman earlier on the slopes of Davos, Matt. He was talking to the team there, and he was talking about how the outflow story is stopping. They're starting to see some inflows, and some bits of the business really doing well in his view.
All right, we'll keep an eye on Credit Suisse and the banks for sure today. Let's get back to the Chinese economy, though, because new GDP data shows it grew at the second slowest pace since the 1970s last year. However, the 3% GDP rise was better than most economists had anticipated. James Mager, Bloomberg economics editor for Greater China, joins us now from Beijing. So, James, China's economic growth surprisingly strong in the final months of the year. What were the drivers of that?
It was a surprisingly strong December. we were expecting a 9% slump in retail sales in September, when it barely fell it fell 1.8%. Industrial output was again much stronger than expected in the data, and that was surprising because December was seen as being a write-off for the economy. Basically, China, the first week of that month was COVID zero, and lots of cities were sort of in a half lockdown state. And then suddenly, on the 7th of December, the government reopened the whole country, and then everyone got COVID. So, it was seen as being the data would be very weak. That doesn't seem to have been the case, at least according to the data that was released today, and that's really boosted the overall performance for the year. You had stronger industrial output than we expected. We had stronger retail sales, stronger investment data, and that seems to have put the economy in a better position for last year, and also is increasing confidence that the rebound this year will be stronger and faster than people had expected.
Okay, James, so while we're talking about the economy growing, we're also talking about the Chinese population shrinking for the first time since the Great Famine in 1961, which is a pretty historic change for the largest country in the world. What does this mean?
This is not a temporary change. This is a permanent change in China's population. You're seeing birth rates come down. Births have fallen now for 6 consecutive years. They were below 10 million last year, and deaths are rising. Obviously, as the nation gets older, those are only going to increase, and we should probably see a spike in deaths this year because, as I just said, the coronavirus is now spreading across the whole country. Most of the deaths that are going to come from that are going to come in 2023. So 2023 is probably going to see fewer births and more deaths again. And even leaving aside the COVID and those kind of temporary measures, once countries go onto this path of falling births and an aging population, it's almost impossible to reverse that. If you look at the case of Japan, South Korea, Taiwan, even countries in Europe as well, once that happens, there's nothing really the government can do, whether it's subsidies, free school, parental leave, that really reverses that in a substantial way. And that's going to change, Chinese demand for commodities. That will change how many Chinese children want to go and study in the UK or want to go and study in the US. So demand for university places overseas. It's going to change, and lots of things about the domestic economy as well. It's a really historic shift that we see today.
Yeah, absolutely. A story that could reach far and wide. James, thank you very much. James Mager, Bloomberg economics editor for Greater China, reporting there from Beijing. Now, global markets got a sugar rush when China reverted to pro-growth policies in late 2022. And some are arguing it's not too late to join the rally. OPEC Secretary General joining the growing chorus of voices bullish on China.
We've been always very bullish on China.
Yep.
China is a big power, economic powerhouse, has significant implications for global oil demand. We saw what happened when China closed down. Now everybody is optimistic about China opening up. So I say yes, we are optimistic, but again, we are cautiously optimistic.
Bloomberg's Danny Berger joins us now for more. Of course, in the short term, Danny, going from COVID zero to COVID everywhere has been a negative, but medium term or even slightly shorter time horizon, there are a lot of voices turning really bullish here.
And I think that's part of the reason why analysts think that not only does this rally have further to run, but a lot further to run. There has been that caution around China trading to some degree. That means that equities, the renminbi, all of them can get stronger from here. That's not fully priced in. So for example, you have cities saying that they think the MSCI China could rally another 20% into the year end. Morgan Stanley, Goldman, they only see about 10%, but still that is higher after already rallying about 40% since the start of November and when we started to get those restrictions easing. And a lot of that has to do with domestic consumption and a services-led recovery. So that stands to reason for things like the onshore yuan. UBS sees that strengthening to 6.5 versus the dollar. And the global implication is one of commodities. A lot of calls, ING thinks oil is going to go above $100 per barrel. Goldman thinks that we will see copper go above $10,000. The things that Matt's dreams are made of, apparently. Jeff Curry really feeding that into his thesis that we have a bullish concoction for the commodities market as a whole. China demand will come back and that supply will remain really tight, Kaylee.
Yeah, I have to say most of my dreams are work related, like I show up late to the show or something. something, but I can't say I've ever dreamed about specific calls. So this is a new one for all of us. Bloomberg's Danny Berger, thank you so much. Now, another story we are watching this morning, revered meme stock investor Ryan Cohen is pushing Alibaba to speed up its share buyback plan after acquiring a minority stake in the Chinese tech giant. For more, we're joined by Bloomberg Quick Takes' Alex Webb. So Alex, A, what's the advantage of buying into Alibaba now? And B, how likely is it that he is going to be able to affect much change at all?
So it's been a punishing few years for the tech giants in China. There was a huge crackdown from the government. They felt that these companies were overextending their reach and their influence. The stocks therefore came down considerably. What we saw in December with the loosening of COVID-0 was a sort of realization from the powers that be that to reinvigorate growth, they needed these tech companies. So there was some comments in the planning meeting in December that suggested they're going to support the tech industry a little bit more. If you look at then buying in, the stock has been trading near historic lows, well below the IPO price as a multiple of forward earnings. It's therefore quite opportune to buy in there with the possibility that it's going to recover. The question is whether he's actually going to be able to affect change. That might be a little bit trickier. His stake, while it might be in the hundreds of millions, is very, very small as a total percentage of Alibaba. Now, nonetheless, Alibaba has in the order of $80 billion in net cash. So maybe he's pushing at an open door here, and it's something that the company is willing to do anyway.
Okay, Alex, good morning. In other tech news, Microsoft says it's going to add ChatGPT to its cloud-based Azure service. That's coming soon. What does that really mean in real terms?
So there are a number of different applications for this. You could just be, if you're working on Microsoft's cloud platform, you could just have this as an assistant. You know, you're designing code, which you're going to ingest into GitHub, another platform that's owned by Microsoft. That can be augmented by ChatGPT. There are other businesses which perhaps we don't know if it's going to be able to, they'll have products where you can use it live on the fly for customer applications. Microsoft, for instance, has chatbots, right? So if you are trying to talk to your telecoms provider, often online, you will have a chatbot that interacts with you to begin with. On the whole, they're not very good. Microsoft provides some of that technology that could potentially be augmented by ChatGPT.
Yeah, they're definitely not very good, but it would be sweet if they were better. All right, Alex, thanks very much. Bloomberg Quick Takes. Alex Webb talking to us about all the tech stories in markets this morning. Now, big bank earnings are going to continue to roll out. Goldman Sachs and Morgan Stanley set to report before the bell. Bloomberg's Charlie Wells joins us now with what to expect from the finance industry. Charlie, what do we got?
Well, Matt, this is maybe less of a dream and more of a nightmare scenario. So analysts and investors are trying to figure out just how bad the wipeout in investment banking revenue is going to be at Goldman and Morgan Stanley. Analysts are expecting it to be down between 50 and 60%. That would put it in line with its peers. JP Morgan posted a miss, revenue down 60% in investment banking. Similar story at Citigroup. Now, when you focus in on Goldman, there are a lot of questions from investors about what its medium-term strategic direction is. This was a difficult year for Goldman. They had a major restructuring, one of the largest in its history. They're also currently in the midst of an incredibly large round of layoffs, again, one of the largest in its history. So a lot of investors are asking, where are we going from here? When you look at Morgan Stanley, there are also headwinds that a lot of these other pure play investment banks have faced. So it will be a question of how bad the damage is there. On the upside, there is the potential from fixed income trading. We'll have to see how well that desk performs. There also could be some upside from wealth management.
Okay, a lot to watch out for then, Charlie. Thank you very much, Charlie Wells, with a preview of Goldman Sachs and Morgan Stanley to report later today. Coming up, we are live, of course, at the World Economic Forum this week. We will be speaking today with Ken Rogoff, Harvard professor and former chief economist at the IMF. Stay tuned this hour for that conversation. Plus, we'll bring you more from our interview with the UBS CEO, Ralph Harmers. He shared his view earlier from the Swiss Alps.
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay.
What do you like most about your job?
I
the people. I mean, ultimately, we're a people business. A lot of what my job is as CEO of the company is to give those people sort of motivation, to tell them where we're going, to encourage them to come up and do their best work, to encourage them to collaborate. Sometimes you sort of think you're almost a psychologist, as you are a business leader, I think, sometimes.
And so what's your best piece of advice?
I love pitches. I love being sort of leading from the front, if you like, and spending times with teams. I love to see the work that we're doing. When we pitch for a piece of new business, often when we come together. So I guess I try and put myself in the seat of the client. And what's the client going to think when they see this work? Are they going to be excited? Is it going to turn their brand around? How's it going to resonate with their consumers? So as much as possible, I think probably I try and play that role.
Welcome back to Bloomberg Surveillance. This is the early edition. We are simulcast on both Bloomberg Radio and on Bloomberg Television. I have a chart showing the Bank of Japan's bond buying sorted by days over the past few years. And for those of you listening on radio, I'll just tell you, they spend a lot of money to uphold yield curve control. In fact, over the last 4 days, Valerie Teitel tells me they've spent over $100 billion. This chart's in yen, but it goes up to $5 trillion on just one day. Joining us now is Bloomberg Markets reporter Justina Lee to tell us, just how much longer, Justina, the Bank of Japan can continue. I mean, they almost have all the bonds anyway, considering how much buying they've been doing.
Yeah, that's right. And they've really opened the Pandora's box there, when they tweaked the policy recently. Now, almost all Bloomberg economists, that was surveyed are expecting no change tomorrow. But I think a lot of people are now talking about a change eventually. And that's for a couple of reasons. I mean, one is that we have seen inflation start to pick up in Japan as well. And another is that, as we have seen in the chart that you put up, I mean, the Bank of Japan really has become this majority owner of Japanese government bonds. And that really is starting to impact market functioning to the extent where liquidity has gotten a lot worse in these bonds.
Okay, yeah, a really interesting piece by our colleague Garfield Reynolds talking about, to Matt's point, if they kept buying at this pace, they've only got, I think, 33 weeks until they've bought up the whole market. They'd be running out of JGBs to buy. Taking the conversation closer to where we are then, Justina, let me ask you about Europe. We've had some comments from Philip Lane, used to be talked of as a dove. I don't know if there are many doves around these days, but the ECB rates must go into restrictive territory, he tells the media. What do you make of those comments?
Yeah, I mean, we have seen a bit of market reaction today with yields going up and stocks coming down. And I think what's interesting is that it kind of echoes what we're also debating, over there in the U.S., which is whether central banks can start slowing down those rate hikes now that we have seen inflation coming down. And this has been especially true in Europe, where inflation has been surprising to the downside. I mean, partly because it's been warm over here, and so kind of gas prices haven't spiked as much. But I think what kind of he's pointing out is that, it's not just about, the energy prices. It's not just about a short-term slowing of inflation. They really kind of want to make sure that expectations for inflation are not getting anchored and to make sure that they're tackling the problem and not just kind of, going back to easing mode, as some people in the market seem to be expecting.
And it is interesting to keep hearing from these ECB officials as the data continues to improve around Europe, and we certainly talked about that at the end of last week in the German context. Thanks to Justina for thoughts on that. Bloomberg's Justina Lee. And for more market analysis, check out MLIV Go on your Bloomberg terminal. That's where you'll find the Markets Live blog. They'll be across all about the Bank of Japan and, of course, everything that's moving markets. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Politics to the world of business. Balance of Power with David Weston brings you news, analysis, and insight from and about politics power players. Balance of Power, weekdays on Bloomberg.
Lisa, you've got to explain this one to me. What does it mean when the White House says we're watching markets carefully?
It means they have a Bloomberg.
I've seen the Bloomberg.
They have.
I've been in and seen it.
Lots of Bloombergs. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg. Lots of Bloomberg.
I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. I've seen the Bloomberg. What does it mean? What does it mean? What does it mean? What does it mean? What does it mean?
It means they have a Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. The British government has escalated its feud with pro-independence forces in Scotland. Prime Minister Rishi Sunak vetoed a contentious new law on gender recognition that was passed by the Scottish Parliament. Sunak's veto came as the administration in Edinburgh pushes for a referendum on full autonomy that London is refusing to permit. In Venezuela, public sector workers mounted the biggest anti-government protest in years. Workers organized at least 50 protests on Monday. In Caracas, teachers were joined by nurses, pensioners, and others demanding more money from the government. They've been falling behind in an economy that has embraced the U.S. dollar. A new report says that international trade will grow more slowly than the global economy over most of the next decade. According to the Boston Consulting Group, the war in Ukraine will reshape strategic alliances and alter the flow of cross-border commerce. The report forecasts that trade will grow at an average 2.3% through 2031. And Nissan and Renault reportedly are nearing an agreement to revamp their alliance. According to Japan's Yomiuri, the deal could be reached this month. The report says Renault will lower its stake in Nissan from 43% to 15%. Meanwhile, Nissan will invest in Renault's new electric vehicle business. Coming up, we will turn our eyes from the auto sector back to the global economy and head to Davos. Lisa Abramowitz will be speaking with Ken Rogoff, Harvard professor and former chief economist at the IMF. This is Bloomberg.
MasterCard introduced PayPass, its first contactless payment system, in 2002, but the technology took some time to gain traction.
I would say we first invested in this many years ago. The adoption rate on this in the early part, even in markets like the UK, Canada, Australia, was fairly slow in the early part. The inflection point of when it really started to hit its stride was when it was used in the transit vertical. So what we figured is, let's get all the transit systems around the globe enabled for contactless technology. That will create muscle memory for the consumer who will like the experience in transit and will use it elsewhere.
How do you judge the revenue proposition for MasterCard with an innovation like that and the adoption and the pace of it?
Look, I mean, for us, we're agnostic as to whether somebody's using the chip technology or the contactless technology or, using the mag stripe, which was the old way of doing business. We earn revenues which are quite similar across both of those. The revenue potential and upside for us comes from the fact that now more spend is being done on card-based forms of payment than was being done in the past. So we're converting that cash over to electronic forms of payment, which is where the incremental revenue comes from.
If contactless payments is the current revolution sweeping the payments industry, what's the next one?
I think pay with your smile. So, biometrics.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia.
This is Count Under the Close.
Welcome to Bloomberg Crypto.
This is Bloomberg Surveillance, the early edition. Here's what you need to know. China's economy is proving more resilient than analysts expected in the face of the COVID outbreak. That's adding to the bullish case for commodities. It's a rare case of an activist targeting a prominent Chinese company. Meme stock investor Ryan Cohen takes a stake in Alibaba and wants the e-commerce giant to buy back more of its own shares. And Goldman Sachs and Morgan Stanley are out with fourth quarter earnings today. We will see if they join their peers with a big drop in M&A fees, of course. I'm Anna Edwards in London, and Matt Miller and Kaylee Lyons are with me in New York. Of course, M&A fears, of course, a feature of this reporting season over in the United States, as they haven't been so easy to come by. That's going to be a big focus, Matt, later on today, isn't it? The reporting season from the US, of course, also dealing with some interesting data out of China overnight.
Yeah, absolutely. And the data out of China, interesting because although it was pretty bad relative to history, it was pretty good relative to expectations. So you're not really seeing that shine through in markets. We still have futures down here, and we have rates higher. So take a look at S&P futures off about 0.25%. We closed in the cash trade right under 4,000 at 39.99, and we're about 12% higher now than we were in the October low. So it's been a steady march up as, I guess, the pessimism has come out of this market, and a lot more people are hopeful for China. A lot more people are hopeful for Europe, also doing better than had been anticipated, as we heard from members of the ECB. So that's good news, but you're not seeing that play through in risk assets today. NYMEX crude coming off a little bit, just about 0.2%, but still holding at almost $80 a barrel. And then Brent, of course, is up a little bit over 85 right now. And then Bitcoin, right now, 21,111. It's coming down a bit, but from what we saw on Friday, from what we saw last month, really it's climbed remarkably back to the levels that it was before the collapse of FTX. So it's as if none of that ever happened for everyone who didn't lose, $8 billion in the exchange. Kaylee, what do you see in terms of pre-market movers?
Well, for all the gains we've been seeing in Bitcoin as of late, Matt, they've been even greater for some of those crypto-related equities, and that is definitely continuing in the early session this morning. Coinbase looking for a sixth consecutive day of gains. That exchange is up about 6.3% before the bell. Already, it's up 40% so far in 2023, so it really goes to show you just how far some of these names have rallied, and that has been especially true for some of the mining stocks in particular, and that is on display once again today. Riot Platforms, of course, formerly Riot Blockchain, up 8.6%, Marathon Digital by more than 10%, Bit Digital by about 32%. And so all three of these examples, Anna, of the rally we have seen in some of these Bitcoin mining stocks, they actually could see their best month in over a year. They're already up 60% or so in the month of January.
So that expression of risk appetite could be to the fore then, Kaylee, today. We're not seeing that in stocks here in Europe. The equity market session in Europe down by 0.25%, but it has been, to Matt's point, a really strong start to the year for global equities, a feature of the China reopening story and the European optimism. Two-year yields in the UK, those yields coming higher as we see that debt being sold off a little bit. The wage data coming in historically high levels, 6.4% in wage growth for the UK economy. Does that put more pressure on the Bank of England to do yet more hiking, even if the Fed is stepping down in the size of its hikes? And the euro, 108.12. Matt was talking about some of the comments from the ECB officials. Philip Lane talking about getting to restrictive territory. We talked about that with our colleague Justina Lee earlier. And natural gas prices down another 2.6% today in Europe on this European benchmark of gas prices. Kaylee, yesterday that number dropped by 14% in session.
Well, of course, Anna, the energy crisis, climate change, the war in Ukraine, the broader global economy, all topics of conversation at the World Economic Forum in Davos this week. So let's go there now, where Bloomberg's Lisa Abramowitz is standing by with Ken Rogoff, Harvard professor and former chief economist at the IMF. Lisa.
Kaylee, thank you so much. It's been an honor to be here and hear some of the conversations as people really try to dissect all the big issues that you're talking about. And our next guest, Kenneth Rogoff of Harvard University, formerly of the IMF, as well as the Federal Reserve, really diving into where we are in the interest rate cycle as it pertains to recession and some of these discussions. So I want to start with this idea that you've talked about, that it was not free. It wasn't a free lunch to have all this cheap debt that then would end up having some problems when rates rose. We haven't seen that. In fact, debt and credit has held in pretty well, and people are looking for this year to be a really good year for those debt instruments. Does that surprise you?
Well, it has surprised me that, we had interest rates go up so much and many pockets of weakness in the global economy, especially in emerging markets. Less has happened than I would have guessed. But at the same time, if you look at the history of debt cycles and interest rate cycles, it's never just one thing. So if just commodity prices are low or just interest rates are high, it's not enough. So if interest rates stay high because inflation stays high and we have a recession, which I still think is a distinct possibility, that's when you're going to start feeling pain.
At this point, though, it's actually been a benefit, ironically, to corporate debt, to government debt, because it has inflated away some of the debt. So it's actually created a boom. So how long could you see that continuing to provide a tailwind to a market that's massive and that has been inflated by these low rates to start with?
So absolutely, we've seen effectively of governments a partial default on debt. I mean, there's been unexpected inflation, probably of the order of cumulatively of 10% or more, and that's a de facto partial default. And so it makes it easier. The question is, and this is also true for corporates, when does that start getting built into rates? And also, I mentioned, I think the real interest rate will be higher. But if we don't have a recession, I think it will be a great year for credit, no doubt about it.
What about in emerging markets? Because a lot of people are going into certain developing areas, especially in light of the fact that we haven't seen the massive disruption that some people were expecting there either.
Yeah, but we are seeing inflation in emerging markets. So a lot of emerging market borrowing has actually been in their own currency, and they have had inflation. So, although it hasn't had the drama necessarily of defaults, not necessarily the case. The returns are going to be fantastic. But sure, emerging markets do well when you don't have a recession, and, we'll see.
You say that you do think that there's going to be some sort of downturn, that we're not out of the woods. What makes you say that?
Well, I think it's a few things, but fundamentally, when we're in an interest rate cycle like this, although markets react very quickly, the effect on the real economy from employment to growth that is, say, 3/4 to 6/4 or even more. There's like many meta studies that sort of come to this conclusion. So that's the trickiest thing about Fed policy and central bank policy is you're driving a car and you have to push on the brakes, a mile before you actually want to stop, and you don't quite know what you're doing. And so there's a lot of uncertainty around it. I think they're going to keep raising rates a little more because inflation's still high. And yeah, I think we're seeing signs of weakness. Of course, if we have peace in the Ukraine or something like that, which would be amazing, that would be an incredible shot in the arm. If we have something go worse there, that'll be really bad.
Well, when you talk about how it takes 3 to 6 quarters to really work its way through the system, what about one of the main industries, both in the U.S. and globally, in real estate? How far into that cycle are we, considering that a lot of people viewed it as the first hit in some ways because of how high mortgage rates got?
So equities and housing move in sync with interest rates, but equities move much faster. Housing famously, prices, especially down, move much more slowly. People just sit on their house. They don't want to sell their house. So if, as I think, interest rates are going to stay high for some time to come, I think there's still a lot of downward adjustment in the housing markets globally, not just in the United States.
What kind of range are you talking about?
Well, I mean, certainly another 10%, I would think, over a couple years still. Housing isn't quite as volatile as equity when you look at the beginning and the end of these cycles, if you look at 2008, for example. But, that'd be off the top of my head, the number I picked.
You said that you expect rates to remain higher for a longer period of time. What kind of level are you looking at, and for how long is a long time?
So there are two components to rates. How long is inflation going to stay high, and how much is the real interest rate going to adjust? And also recessions, I should say, is mixed in there. So if you look at what happened after 2008, inflation fell, but interest rates fell much more. Like on average, forward-looking real interest rates were falling 200 basis points over that period, peak to trough even more. So what I see longer runs, we're looking past whatever recession might happen, inflation will eventually come down, maybe just to 2.5%, not to 2%, but interest rates are not going to come down to the same level as they were before. They're not going to come down to the same level as we saw. I wouldn't be surprised to have, say, a Fed funds rate of 3.5 quite a while from now, and a 10-year rate of 4, for example, even three years out.
When you talk about, just to revert back, the consequences of that with housing, you talk about the global housing market possibly seeing another 10% decline, at least in the next couple of years. How does China factor into that? I know it's an idiosyncratic story, but you've done a lot of work on that, and we've seen some of that pain come through with developer bankruptcies and other types of losses.
So I think China won't have a Western-style financial crisis, but I think there's no question they reached a point where they're overbuilt. Housing, commercial real estate, infrastructure, and of course those of your viewers who've gone to Beijing and Shenzhen and Guangzhou, Shanghai, what are you talking about? Like, it just seems thriving. Well, go out to the equivalent of the Cincinnatis of China, which are 10 times bigger in population. They also have amazing office buildings and housing. In fact, I think something like 88% of the roads are out there, a lot of bridges, infrastructure. And just as the Soviet Union came to the end of the line with its steel and cement plants, Japan with its bridges to nowhere, I think China's reached that point. And it's got a big adjustment to make. I think that's something among the many challenges China faces that's not something they can just turn a dial. They've got rid of the 3 red lines to try to improve the short term, but it's overbuilt. And I don't think, and especially in these tier 3 cities where the jobs didn't come, that's the Cincinnatis, where the jobs didn't come, where people are starting to leave, where prices are falling, and there's not a quick fix to that.
20 seconds. What's the question we're going to be asking about crypto, because you don't think that it's necessarily dead in 2 years from now?
Well, it's going to need to be regulated a lot. I favor, strong regulation, but that's can't be done by one country. If it's still legal in Russia, you can still own it here and potentially spend it. Maybe Russia wasn't the best example, but it's going to probably remain legal in a number of countries where the government doesn't completely control the country, so that's going to give it value.
All right, Ken Rogoff, thank you so much for being with us here in Davos. Back to you, Anna.
Lisa, thank you very much. Lisa Abramowitz with Ken Rogoff in Davos, ending that conversation on the possibility of regulatory arbitrage within the crypto space. One for the crypto show later on today and in other episodes, perhaps. We'll have much more from Davos throughout the day, including Lisa's interview with the Chevron CEO. Mike Wirth joins the Bloomberg team. That's at 8:30 a.m. in New York, 1:30 p.m. in London. This is Bloomberg.
Humanity consumes 500 billion cups of coffee every year. That's almost double what we consumed a decade ago. And yet, coffee production is one of the most antiquated industries in all of agriculture. Climate pressures like drought, heat, and blight are affecting food producers in different ways all over the world, as climate change becomes something we can taste. In the past year, hundreds of thousands of acres of coffee plantations were wiped out. What's at stake are the livelihoods of around 125 million people. Because, if you're being honest, this is a plant that cannot hold on much longer in a changing climate.
A special Wall Street Week from the World Economic Forum in Davos, Switzerland.
This is Bloomberg Wall Street Week. I'm David Weston.
Join Bloomberg's David Weston as he engages with the foremost business, political, and cultural leaders for discussions on wealth inequality, global power dynamics, and more. Accountability, solution-driven conversations, data insight. This Friday at 6 p.m. Eastern, only on Bloomberg Television and Radio, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Well, it's another big day for the big banks. They'll remain in focus as Goldman Sachs and Morgan Stanley are set to report their earnings before the opening bell in just a few hours' time here in New York. Shonali Bostic, our global finance correspondent, is joining us now for a preview. So, Shonali, what's the read-through going to be from the JP Morgan and Citigroups of last week to Goldman and Morgan Stanley today?
Well, what you saw on Friday was a lot of the market shaking off concerns about the consumer despite provisions rising. Now, if you turn back to today, we're focused on core institutional businesses. We're focused on trading. We're focused on investment banking. And when you look at the bar that's already set by Wall Street right now, based on the estimates, the bar is pretty low. There's a lot of room here for beating in fixed income, particularly for Goldman Sachs. So you want to see them come in higher than expectations there to please the market. But when you come to Morgan Stanley, they're bigger in equities trading. So it's the competitive dynamic there I would watch. All through last year, you saw them neck and neck, and you saw a couple quarters there where Goldman came in above Morgan Stanley in a business that Morgan Stanley has traditionally been bigger at in equities trading.
All right, so we'll be focused very much on the trading numbers as usual. You mentioned investment banking as well. What about M&A? What about IPOs? What about bond issuance? Is this year going to be good for that, or are we looking for bad news on that front?
So, of course, there's expected to be a drop-off. I would watch Morgan Stanley's numbers pretty carefully because if you look at the league tables, Goldman's lead was very significant when you look at JP Morgan and Morgan Stanley. Goldman is expected to still, in a bad year, bring in more than $1 billion in the quarter for advisory revenues. Now, if you look at this year, JP Morgan has already said that the pipeline has been building, but it depends on how the year goes, really. We'll want to see if Morgan Stanley in particular brings up leverage finance, given that Twitter deal overhang that has existed. We saw JP Morgan kind of shake off some of those leverage finance concerns and say they're in the market, they're open for business, and Jamie Dimon himself said he's not overly concerned about that business right now.
Sonali, staffing levels and the future of the workforce springs to mind when you think about these types of businesses, in particular Goldman Sachs.
Yeah, in particular Goldman Sachs. If you take a look at it, Anna, let me put this in context to you by the numbers for a second here, because Goldman Sachs is expected to bring in an efficiency ratio of less than 69%. By comparison, for Morgan Stanley, that's 75% or higher. But if you look at returns on equity, Morgan Stanley is still supposed to post a higher result in that regard. So really, this is a matter of profitability. You have to keep a clamp down on costs here in some way. You're seeing that happen in terms of larger headcounts over at Goldman Sachs. I think Morgan Stanley is going to have to answer if the conditions change in the environment here, whether they're going to have to make steeper cuts than they already have. For Goldman, remember, we've been talking about it, the number, while it is large, it still only brings you back to about a year ago in terms of headcount. So Goldman's strategic realignment here and how much of those cuts come from investment banking and trading and what that means for their competitive dynamic is important, especially as we watch them break out for the first time their new segments here in which they are reporting differently, especially for that consumer business where everyone is going to be watching very closely in how they pivot that business into the investor day that's at the end of February.
Well, to that point, Sonali, we learned Friday that Platform Solutions business lost $1.2 billion in the first 9 months of 2022. I would imagine there's going to be some questions about that on the call. Where else do you think analysts are going to be focusing? What are they going to be looking for when they hear from these executives today?
I think two things. On Goldman, of course, it's at $1.2 billion. That's actually supposed to be $2 billion about for the full year. So it's a significant number. That's about $4 billion over the last couple of years. Some of that is provisions, but some of that is straight expenses. So what can be cut? I think also how you invest into the environment still. Costs have been the story of the year. The costs will continue to be the story when you look into this year. The other thing I would say is if you're scaling back some of these consumer ambitions, you have to watch asset and wealth more closely, especially in this choppy environment. Goldman is doubling down on this business. Well, guess what? So is Morgan Stanley. So is JP Morgan. So even there, the competition is pretty stark. I think one bellwether sign for the industry that is kind of good news here is that BlackRock number kind of coming back up when it comes to the passive numbers. So when you look at what Morgan Stanley is doing and kind of shifting to some of that passive, there will be questions about what kind of share they can gain, how much net interest income will be a boon for them because they lend to the wealthier segments here.
Right.
And similarly for Goldman Sachs, whether they can kind of compete on that scale.
Sonali, thanks very much. Bloomberg's Sonali Basak on all the ways that these businesses are competing with each other and some of the things to watch as we hear from Goldman Sachs and Morgan Stanley. Coming up, The View from Davos will bring you part of our interview with the UBS CEO, Ralph Amers, who tells a very different story when it comes to hiring compared to Goldman Sachs. More on that next. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kaylee Lyons here in New York. Anna Edwards with us out of London. Now, UBS CEO Ralph Hammers believes inflation will stay higher for longer. He spoke to Bloomberg's Manus Craney earlier in Davos.
Just go back last year, the war, the sanctions, the energy crisis, supply chain still faltering. I do think that the opening up of China, the impulse it gives to consumption in China, energy need, commodity need in China as well, I do think it's a very good signal. It will be supportive of a momentum, but the true inflection point we have not kind of seen yet.
The natural corollary to that is you as a house were way ahead on your call on China. You've reaffirmed it this morning. Is that movement from China, has that been reflected by the clients? Are they much more active in taking China risk?
Well, we've seen more activities, but we have certainly advised them to go long on China and to be overweight on China. That's what we came out with on time, I guess. I think we were all a bit surprised as to the speed at which China opened up, but I think. Advising the clients, and they really have come, and you know that from the third quarter, clients in periods like this need more and more advice. They really come to me, I'm talking to them, and they're saying, well, okay, help me reading these data, help me reading these trends, where should we go? And basically they put a lot of money with us to manage for them, right, in the third quarter.
And are you saying cash first, reflect, and wait for a pivot? Or are you saying actively deploy, but judiciously? Which is the narrative for you?
We're still cautious as to the balance that you bring, and but there is moments to invest. There is absolutely moments to invest.
The other big debate is this: peak inflation, peak rates, and peak liquidity. Now, there's two bids there, and there's one offer. If I look at the inflation narrative, the consensus is building peak inflation, and it will drop precipitously. Are you expecting a precipitous drop in inflation?
We are expecting that every month we will see a further decrease. I think that inflation at higher rates than what we're used to is here to stay. And there's a reason for that. If we truly look at what has happened to us in the world over the last 3 years, we do think that we're going into the era of security. It's energy security, it is about food security, it's about technology security. For that, part of the supply chains that we are still dependent on will have to be rolled back, which basically means you bring labor back, you have to invest. The energy transition is still at its infancy, at its start. Lots of investments will have to go into becoming less dependent on energy from other countries. So I do think that inflation will be higher than what we are used to in the past. So it will not come down to the 2% that we are used to. So we'll have to work with that, but it will decrease from here.
UBS CEO in Davos. We're in Davos. We're also in Berlin. Coming up later today, an exclusive interview between our editor-in-chief, John Micklethwait, and the German Chancellor, Olaf Scholz, live from Germany. This is Bloomberg.
Today, what are the biggest challenges for General Dynamics and what are the biggest opportunities?
So I think in any business, the challenges are solving complex problems that come to you. You know, the problems that come to me and my senior leadership team for resolving tend to be highly complex and nettlesome. So your ability to solve those complex problems are an important element, I think, of the value that we add to the company. And then I think opportunities, you always want to make sure that you've got a creative enough mind, an open enough mind to be able to see around square corners. What am I missing? You know, the why questions are really powerful. Why are we not doing this, or why are we doing this? I ask those questions a lot, and in the answers, you can sometimes tease out some real opportunities, some hidden things. But thinking creatively about opportunities and problems is really important.
And what about the industry generally? Do you think they have big challenges now as the defense budget probably comes down a bit?
So I think that we are all responsible, and we have an obligation to find the latest and best technologies that we can for our customers and deliver them in the most cost-effective manner we can. And I think that that's a challenge and an opportunity for all of the big defense companies.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
This is Bloomberg.
Let's pull the camera back and think long term.
If we do go into a recession, it will be a mild one.
Consumers still seem to be spending. The labor market still seems to be strong.
You could have goods deflation this year. That is a very different story to last year when U.S. inflation was accelerating.
We're getting more confidence, especially for the large banks.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
I told you, you drink at the airport, you miss flights.
You miss flights. I missed the damn flight. I'm sorry.
Live from New York City this morning. New York. Good morning for our audience worldwide. Alongside Tom Keene, I'm Jonathan Farrow. This is Bloomberg Surveillance. Equity futures right now on the S&P down 0.25%. TK, what a difference a rally makes. 4-day winning streak on the S&P. And all of a sudden, the 2023 consensus shattered.
It's all going to be, I was really thinking about this seriously today, John. You and I have an envious ability. We can really not have an opinion. People are paid to have opinions, and they're recalibrating the opinion right now. The zeitgeist over the weekend was more in the bond market, price up, yield down, bonds doing better. But again, equities with a VIX of 20.07 have been better than good.
I tell you, Mike Wilson of Morgan Stanley is not changing his opinion. Let's bring up the quote from Mike this morning, him and the team publishing a little bit earlier on. Bear markets are like a hall of mirrors designed to confuse investors and take their money. He went on to say, trust your fundamental process. For us, margins, earnings, Tom, are likely to significantly disappoint whether there is a recession or not? That's Mike Wilson of Morgan Stanley this morning.
We'll look at margins and earnings here. What do we have at 7:30, John? Goldman Sachs?
And
That's
Morgan
going to be
Stanley too,
interesting.
yeah.
I mean, they've got, Shanali had the recalibration of what they're doing in their consumer product area with layoffs and such. And then Morgan Stanley, perhaps a victory lap there as they continue to consolidate Eaton Vance and E-Trade.
Looking to wrap up earnings on Wall Street a little bit later this morning. Good morning to you. Let's wrap up the markets for you. Equity futures, as I say, just a little softer on the S&P. No real drama, though. 4-day winning streak on the S&P. Believe it or not, the longest daily winning streak going back to
Above
September
4,000
last year. Will we snap that winning streak today? In the bond market, yields just a little bit higher by 4 basis points on a 10-year, 354.76 on a US 10-year yield this morning. Tom, I was going through the numbers out of Europe. Euro Stoxx 50 year to date, up 9.6%. EM equities year to date up 7.8%. And if you want to pick a single name this morning, let's take LVMH. LVMH is up more than 16% year to date so far. What have we had? 9 trading days.
Some of that's a
trading
Euro
days.
play, but we got a number of things going on here as we were sat, and particularly with Francine and the team at the meetings of the World Economic Forum. And John, what I would focus here on the reset is everything is overwhelmed by the presumed China opening, and against that, the challenges of Japan. Those are the backstories, and our lead guest here to get us started on Monday will help us with that a lot.
Al Salinas, Global Head of FX Strategy at RBC, joined us right now. Al, so we'll talk about the BOJ in just a moment. I think investors not interested in good versus bad, but better versus worse. Are things getting better or worse?
So it feels like you've got conflicting signals coming at the moment, a muddled outlook for many, in that if you look at the equity market, as you highlighted at the start, huge rallies to start the year, some real optimism airing in. At the same time, yields moving lower, so bonds rallying. It's that kind of bond equity rally that's the perfect storm for the US dollar. But it does feel like there's a bit of a conflict between the messages we're getting from the two sides.
Do you think that move we've seen in the dollar so far is sustainable? Are there some sustainable headwinds against the US dollar that you think last through 2023? We've had a 10% plus move since the end of September, Al, so that's quite a move.
Exactly, and I think the danger is we're falling into the same traps that markets fell into at the start of 22 and at the start of 21, where everybody starts the year with a very strongly bearish dollar consensus. I know it feels weird given how strong the dollar was in 22, but that was the consensus at the start of the year. And we spend all of January putting on those positions, and then it snaps back. Whether it snaps back in February, March, whether this year takes a little bit longer, maybe in the back half of the year, it's not going to be quite as straightforward as just sell dollars and close your eyes.
Elsa, Lisa Abramowitz in the last hour with Kenneth Rogoff at Davos and the World Economic Forum, and they're talking there about the Fed and about this relentless rate increase. Against that is the distraction of Japan. I thought Ambrose Evans Pritchard in the Telegraph with Professor Rogoff today with a nod to Olivier Blanchard was just brilliant. The giant wild card, Japanese inflation, has returned in the aftermath of COVID, pushing the country from a bad but stable equilibrium into an unstable equilibrium. And just for perspective, folks, Japan owns 8% of France's public debt. Elsa, how do you synthesize the Japanese conundrum?
That's a really interesting point, Tom, because we've actually started to see it in the data coming out from Japan. They have turned into sellers of European government debt. And as you highlight, they are big holders of French government bonds. My colleague Adam Cole has done a lot of fantastic work on this, and though they've been selling treasuries in large size for a while, the last few months have been notable in that we've seen EGBs take the lead. Why is that happening?
Right.
Well, it's the cost of hedging. It's euro-yen and the cost of hedging that exposure.
What you do on this, and AEP has a wonderful chart on this, is you take the yen swap yield versus the published yield, the one, folks, that John Farrell follows so closely. And there's a huge gap. Where does dollar-yen go on that presumed gap? Can you get to 120, or dare I say an even stronger yen down to parity?
So I'd actually look at it the other way and say, unless the Fed is going to be cutting rates dramatically in 2023, and we're not talking 1 or 2 cuts, but really slashing rates, under most other scenarios, the cost of hedging continues to rise for Japanese investors. They're actually going to have to reduce those hedge ratios. Dollar-yen goes higher. I know that's not a popular thing to say. But that could be what we see for the balance of the year as a whole.
So can we talk about the BOJ this week? There is massive speculation. They're going to adjust yield curve control, maybe drop it all together, adjust the band, move the maturity they focus on. What are you focused on?
So it's the combination of factors, right? It's yield curve control coupled with the inflation forecast. A lot of speculation that Kuroda's going to want to leave a clean slate for the next incoming Bank of Japan governor in April. It may not happen today. Actually, I think most analysts expect it to happen in March. But as you said, a huge amount of speculation. We've actually gone long Swiss yen into this meeting, only because we might be getting a bit ahead of ourselves in terms of how much we're expecting for tonight.
So that's long Swissy against the Japanese yen, looking for a weaker Japanese yen here, Alsa.
That's right.
Alsa with a call there, Tom. Long Swissy against the Japanese yen.
This is
expecting the JGB, or rather the BOJ, to disappoint a little bit.
And this is important, folks, in that you don't look at just dollar against a pair. There's other cross rates as well. Elsa, what do you do on the Pacific Rim? If we have an opening up, John mentions Europe on a relative basis off the mat doing better. But as a Pacific Rim play, what does RBC Capital Markets look for? What's the best pair?
So we've been looking at a number of pairs. The Australian dollar, we don't typically love it, but actually there have been good opportunities. We were long Aussie against CAD last week, and it's something we'll look to revisit on and off as the year goes on. There has been a lot of speculation, a lot of positioning around China reopening, but that may have a little bit further to run. And not just the reopening, but also apparent thawing in relations between Australia and China that I think is worth paying close attention to.
You know, I look, Elsa, at the moment, as John mentions, it's a Bank of Japan week. Everybody's radar is off Europe. What are the degrees of freedom that Christine Lagarde has right now? She's the least talked about, I would suggest, right now, and all my radar's up on that.
Yeah, she's probably happy to be out of the spotlight for a bit, right? But there was a really interesting interview this morning given by Philip Lane, the chief European economist, and he was highlighting that rates will have to rise further, but that Europe is facing a shock in terms of energy prices that the US is not facing. And that at the end of the day, that does mean rates will have to rise less in Europe than they have risen in the US. I think that's an important reminder to just, there are critical differences between here and the other side of the Atlantic.
I look at, Elsa, the moment in foreign exchange, and it is about a certain weak dollar. What is the level of weak dollar? I think it's so important to reset going into the end of March into April. How much is the weak dollar move going to be?
Look, I think in terms of the year as a whole, I actually expect, and again, I know this is going to sound controversial, I actually expect the dollar to end a little bit stronger, certainly across the yen and probably against the euro as well, just given where we are now. How far we overextend into the end of March is really anybody's guess, because I do think that momentum for the weak dollar trade has some more legs, has further to run. But again, as I said, I would be looking for that as an opportunity to reposition for a slightly stronger dollar in the back half of the year.
Just the final one from me. What's the number one factor behind that dollar strength that you anticipate in the back half of 23?
Combination of the Fed potentially not easing as much as people anticipate, coupled with the fact that, as you said earlier, we've had a 10% move since September. We've priced a lot of that story in already.
An amazing turn we've seen in a couple of weeks, 9 trading days, Alsa, and all of a sudden a lot of people changing their minds. Alsa Linos of RBC. We talk about the South Side a lot, Tom, setting the consensus, shaping a consensus. The South Side doesn't shape the consensus, the price action does. The price action of the last couple of weeks has shaken everyone up.
We have to be very careful here about, tar and feathering people that got it wrong, or, giving somebody a victory lap this early in the year. The fact is, the uncertainty is because of the pandemic, the opening in China, still the supply side dynamics that are unknown and original. Nobody's ever really faced this, John, bouncing over to conventional central bank in interest rate theory. And you bet that in the foreign exchange market. That's the deepest market. It's the biggest market. It's the easiest place to make bets.
As you know, Tom, and we mentioned this a little bit earlier this morning, investors aren't preoccupied with good versus bad. It's better versus worse. And I think capturing that perfectly is the view of Deutsche Bank going into the weekend on the German economy. They wrote this on the German economy.
I missed that.
We now expect annual GDP growth to stagnate in 2023. That's not great, is it? But the fact of the matter is, it's better than they anticipated a few months ago, because they're no longer looking for a recession. Now, that's the argument. That's the argument you face right now. Things are arguably better now than they were 3 months ago. Do you expect that to last the rest of the year? And the mistake you can make is take the first couple of weeks of trading of any given year, Tom, and then extrapolate that out through the next 12 months. This is going to be a bumpy ride.
It's a territory of Anne-Marie Horton and Maria Tadeo, but I would suggest coming up with recession depth and magnitude in Europe is very difficult. when you have some form of missile that's supposed to take out aircraft carriers landing on residential buildings within Ukraine. And you overlay the war on this, and I have real trouble with anybody giving me certitude.
Euro-dollar right now, 108.24. Anne-Marie, AMH down in Washington, D.C. in just a moment. Let's whip through the price action briefly and get you up to speed on what you're waking up to this Tuesday morning. Equity futures down about 11 points on the S&P. We're down a third of 1%. Coming into Tuesday, 4-day winning streak on the S&P. Will that stick? In the bond market, yields a little bit higher, up 4 basis points on a 10-year, 354.57. We wrap up bank earnings a little bit later this morning with Morgan Stanley and Goldman Sachs. And then we'll have a little look ahead as well to tech earnings a little bit later this week with Netflix, then on to Apple in early February, Tom.
Brent crude, $85, small matter. There it
WTI,
is, underreported,
80.
undervisible. Jeff Curry, I know, floating around within the zeitgeist this morning. Just this, just a little bit.
What is that? What is that?
Just nudging.
What
it's
is
sort
that?
of a nudging. You know, it's just.
Okay.
On radio, it looks good.
I'm sure that really.
Good morning on radio nationwide, I should say.
Good morning to you all. We can now head over to Switzerland, to the World Economic Forum, I'm pleased to say. Bloomberg's Francine Lacqua speaking with Larry Fink, the BlackRock CEO, at the Bloomberg Year Ahead event.
I'll give you a major theme. Probably the big theme is hope. That is my word of the moment that I'm really using it. I'm using it here.
Hope for a better economy?
No, the whole concept of hope. COVID has really changed how we think. The fear of mortality was developing the world. The polarization, the politics, a war. If you look at birth rates in the world, they're collapsing in the developed world. I mean, you don't bring a child in the world unless you believe tomorrow is better than today. If you look at the savings rates in the world, the savings rates have mounted up dramatically in the world. BlackRock is a firm that tries to sell hope because why would anybody put something into a 30-year obligation unless you believe something is better in 30 years? And more and more money has been held. In China alone, there is estimated $2.7 trillion of more savings in the system. It's in the savings rates in China are in the high 40s. People are not investing in the future. They don't have that, the safety nets of healthcare and retirement. And so we're losing hope. And the polarization of politics, which media source do I even believe in?
Bloomberg.
Okay, fine. You need to get that out. No, but Francine, more and more people are frightened of the realities of today, and that's manifesting in so many areas, and so that's going to be a major theme. And I talk about that a lot today.
If you look at hope, then it has to be backed up by a better world, a better economic situation, inflation going down. How do you see that progressing?
Well, that's when I talk about hope, I'm not talking about, whether the markets are up or down in the next 12 months.
But standards of living.
Pardon me? But standard of livings have to grow, obviously, wages, and we're seeing that. And people have to feel more comfortable. And I'm not just talking about a phenomenon in Western Europe or North America. I'm talking about the world. And there's less hope in the world today.
Do you see the world, though, getting better, so economically?
Sure. Look at, last year was a year of transition in so many ways. I mean, obviously, the first time in 40 years, and this impacted BlackRock in our earnings that I reported on Friday, we had bond market down 13%, global equity markets down 18%, and then for us, the dollar appreciated dramatically. But if you were on a desert island for all of last year and you had a pool of money today, you have greater abilities to invest today than you did a year ago and 2 years ago. If you look at a normal retirement portfolio, this is something that we don't spend enough time on. A typical retirement portfolio in around 2002-03, you could have owned 40 to 60% in bonds and earned your return of 7 7/8 and 8. By 2020, you could not own a bond. I mean, so you had to take so much illiquid risk. I mean, think about the growth in privates and private equity. Why? Because you could not make a return in bonds. Today, with You could get 4% in the short-term treasury, you get 5% in credit, 8% in.
Right.
You could now go back and have I would say a better portfolio, a better asset allocation today than 3 years ago. You could reformulate it and bring down your illiquidity risk. And the question that we all have to ask as investors, do you believe we're going to have more liquidity in 5 years than we do now? I don't think so. I think we're not going to have the support of Federal Reserve for years to come, or central banks. We saw the limits of fiscal stimulus in the UK, and every other government is now facing that. And so the reality is we are going to have less liquidity, and it has to be market-based liquidity. So how much illiquidity do you want if you're running a retirement plan? And so the big issue is bonds play a bigger role today than they did in the last 7, 8 years.
Where do you put your money in the next 12 months?
Look, I'm an optimist. I've had a portfolio in equities my whole life, or some form of equity-related assets. Even at my age, I'm not changing that view. So I don't allow markets like today. Getting back to PEs. PEs are more realistic today than they were 2 years ago. I could go on and on and on. We're spending so much time focusing on the tragedy or the recalibration of last year. But the reality is there are better valuations in companies today than there were 2 years ago. You can earn a better return in bonds than you did 2 years ago. And so we're festering on what happened last year and all the travails. And we're talking about, oh gosh, is inflation going to be, how fast is it going to fall? Let me be clear, inflation is falling. The question is, can it fall to a 2% rate, which I question it will. I don't even know why we have a 2% target. I've raised that question many times. Could inflation be brought down to 3.5? Absolutely. Now, does that mean the central banks are going to keep rates higher for longer? Maybe, and that's the issue that I have related to liquidity.
So you think
Larry Fink of BlackRock there, sitting down with Bloomberg's Francine Lacroix. You can continue watching the conversation on LiveGo on the Bloomberg terminal if you are a subscriber. Tom Keene, alongside me, Jonathan Ferro, live from New York. This is Bloomberg Surveillance on TV and radio. Hope, TK. Have you got hope for a better future?
Well, yeah, no, it's hopium. I mean, that's what's out there. Lawrence Fink is different than most CEOs. He's been heavily vetted to be Secretary of Treasury at given times. He's certainly someone that's really led the charge on ESG, which at Davos is under great threat this year. With the return of King Coal, there'll be a new ESG presumed forward, given some form of end of the war in Ukraine, the future of Mr. Putin. But Larry's a guy that mixes a real prodigious fixed income ability, that's the foundation of his BlackRock, with a lot of conceptual stuff like what we heard there on Hope.
You get the feeling that a lot of these asset managers are taking the opportunity to attract some capital to their bond funds. Don't you think, coming into 2023, bit of a change?
Yeah, and what's interesting here, and this goes to the promenade folks, where, with 20 years there, you walk down and you see a change promenade over the years. A promenade used to be a lot of buy-side houses, including or whatever it is, as well. And the answer here is in 2023, up Happy Valley, they're hoping for the return of active management. To the immense credit of Mr. Fink and others, they've been a little more indexy than others.
Back then it was called
Aberdeen. Are you
Aberdeen.
laughing at me?
No, I'm laughing because back then it was called Aberdeen, wasn't it?
It was back then, it was called Aberdeen.
Mr. Gilbert.
And to Mr. Fink's credit, he has been consistent that it is BlackRock, with their better than good earnings that they showed.
They're not going to drop the vows over at that asset manager.
They're not going to go,
okay.
It's not going to happen.
Equities right now down about 1/3 of 1% on the S&P, just to kick off the trading week. Equity futures negative 1/3 of 1% and down about 11 points. Yields a little bit higher, Tom, up 4 basis points. Your 10-year 354.57. You mentioned it a few times, Tom. Crude close to 80 on WTI, 79.97 this morning.
This is the quiet story of the year, and it's global recovery. And what we see, you talk about hope, the hope of China extricating itself. Some of the death count of COVID in China is really...
And population decline as well. Do you see that headline this morning?
Yeah, and again, out of Davos here, a Chinese authority in full presence at Davos, the confident China growth is most likely to return to normal. China will always promote all-round opening up. Hope from China. Right now, we hope you can put up with Anne-Marie Horton. She is Bloomberg Washington correspondent and joins us this morning. Just a general question. A beleaguered president who spends a lot of time at other houses and documents. How was the president's weekend, Anne-Marie? It seemed to be a little calmer than the previous weekends.
Well, yeah, that's right. He was in Atlanta giving a speech, of course, at the church that Martin Luther King Jr. was a pastor at, and this was him celebrating the life and legacy of Martin Luther King Jr. But of course, if he's eyeing a 2024 run, Georgia is going to be a really important and key battleground state. That's a must-win for him. But then also he was out talking, and of course the debt ceiling came up and what the Republicans are doing, and he had called them fiscally demented. And this comes on the heels of Republicans, the representative from Kentucky, who's the chair of the Oversight Committee, asking the chief of staff, Ron Klain, to release the individuals, a log of who goes in and out of President Biden's home, which of course they do not do for personal residences of presidents. The White House was quick to say that at least this administration, unlike the prior administration, releases logs of who sees the president at the White House in the West Wing.
What's the date calendar for our debt crisis that we have? I've been briefed by you and others that it's into autumn or late summer that we would see a debt crisis, and yet right now we seem very crisisy. What's the week's events or even into the end of January?
Well, it's crisisy at the moment, if that's even a word, because Secretary Yellen had said last week that she will have to start using special maneuvers to make sure we can pay our obligations starting this Thursday. So for me, that's the first ringing of the alarm for Congress to try to get in a room and figure out what they're going to do. But we do know, and Representative Gonzalez on Fox News on Sunday made this pretty clear, the debt ceiling is going to be a knife fight.
Let's not make that a word.
Were you laughing at me?
Yeah, I just don't think that's not a word, and I don't
You're
think we should make that a word.
If Lisa was here, this wouldn't happen.
You reckon? We catching up with Lisa later this hour?
Yes, we are.
Look forward to
in
that.
Davos.
Very cool. Hey, mate, just a final one from me. Secretary Yellen's on her way to Switzerland, just not Davos, right? There's going to be a stop there on the way to somewhere else, and she's meeting with the Chinese. Why there? Why now? And what about?
Well, the Chinese Premier Liu He is going to also be at Davos, but they're going to be meeting. And honestly, this is going to be the more important meeting because everyone at Davos is going to want to know what comes out of her sit down with the Chinese premier in Zurich, less than 100 miles away from the Swiss mountain tops of Davos, where all these elites. They want to know what China trade, this relationship with the United States looks like going forward. It comes on the heels of Xi Jinping and Biden, of course, sitting down at the G20, and then it also comes ahead of we have Blinken very much expected to go to China at some point this year, early this year. So this is just about them talking a number of issues and follow-ons from Xi Jinping and Biden's meeting. But there are moments where this can be contentious, right? The U.S. and China do not have similar views when it comes to human rights, when it comes to trade, when it comes to Taiwan. So it'll be interesting what comes out of this. Also, Treasury Secretary Yellen had told Bloomberg in November that Xi Jinping's firmer grip on the government and some leaders leaving his government potentially may change the outlook for how China grows. So maybe this is also a fact-finding mission for her.
Well, let's start with tone and then go to policy. So the tone has shifted. Maybe it's a little bit softer based on what you've heard from several Chinese officials in the last couple of weeks. Does that tell you anything, Anne-Marie, about the trajectory for policy, the shifts we could expect, anticipate in the months, years ahead?
Well, I think this just is an opening of dialogue. But in terms of policy shifts, it's very hard to see that, especially when, tomorrow you have Yellen sitting down with China's premier. But at the same time, today you have the head of Netherlands, Rutte, going to be sitting down with President Biden in the Oval Office. And the U.S. is trying to convince the Netherlands to their gem, ASML, to not send advanced technology to China, which is a major player and one of their major customers. So this is what they also did last week with the Japanese. So at the same time, you have Yellen sitting down with the Chinese, and obviously trade is super important. These export controls is something China does not want to see. The United States is coalescing other allies to follow in their lead in terms of this policy.
Anne-Marie, thank you. AMH down in Washington, D.C. AMH will catch up with you in the next hour. Equities, Tom, a focus for many of you, I know, but right now I think foreign exchange for me and you. Dollar yen 128.92. And a focus on Japan a little bit later this week.
It's a mix of it. We've got like 20 pairs on my screen here under equities, bonds, currencies, commodities. You can look at all the different ones. Some of the EM ones unraveling due to idiosyncratic ideas. Some of them doing better. Mexican peso, I note 18.81. But I think it is a time to look at the majors and the mixer. You mentioned Swiss yen earlier, and it also is the economic data. So you look at what we don't look at, which is yen, Japan, in their morning of the 19th, a day and a half from now, where they will see national CPI statistics. I see on the Bloomberg screen.
And we get the forecast this week too.
4% number.
We get the forecast this week too from the BOJ.
Yeah. And all of my work on this, I've never envisioned. I've never thought about Japan with a 4% inflation statistic that turns upside down their domestic.
There's so much has changed coming into 23, and I think it started with the BOJ at the back end
John,
of
you need
22.
Mr. Fink says you need hope.
That sounded like a salesman, didn't he? We sell hope. We're in the business of selling hope. Dollar yen right now, 128.91. BOJ a story for later this week.
Stay with us.
Let's get to the story right now. Bloomberg's David Weston, our good friend and colleague, speaking with Jane Fraser of Citi in Davos at the Bloomberg Year Ahead event.
And that translates into, Larry touched on a few of them, but it translates into energy security, it translates to food, water security, financial security these days. The list goes on.